you look at tech, it continues to reinvent itself over and over.
People are jumping on the stories that look sustainable.
The big picture here, I think, in terms of the economy is it continues to expand.
There's no way, in our opinion, that the Fed is going to be easing financial conditions anytime soon.
I think they probably try to hold all year, but then next year start to cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Bramo is away, so this show is going to be totally unhinged for 3 hours. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market just slightly soft and negative on the S&P 500, down a touch after AI went absolutely nuts yesterday, Tom, in the stock market.
Really historic day. I think Lisa really grabbed it earlier than I did. I mean, the scale of the move is extraordinary. Let's pause for a moment on that. A very important Friday here and some terrific guests coming up. The pros look at standard deviation jumps. It was a 4.4 standard deviation move. Jump up in NVIDIA. And what I was unprepared for, John, is you go to the MEMB panel on the Bloomberg and you look at the NASDAQ 100. And, you know, I sort of frame in my head, John, 25%, 27% of the big guys gone. That's ancient history, like 6 months ago. Line them up. Microsoft, Apple, now NVIDIA, brand new, Amazon, Google, Meta. You ready? 51% of the NASDAQ 100. Never have I framed that, let alone said it.
Year to date, the NASDAQ 100 up about 27%. But some of these names, listen to this. NVIDIA, year to date, up about 160%. Meta, year to date, up about 110%. Great note from Michael Hartnett over at Bank of America this morning. The title, Bonds and Bubbles. He said 4% real yields popped the internet bubble, 3% pop subprime, 250 crashed crypto. The market is saying 150 basis points, Tom, too low to pop AI.
Yeah, well, to pop AI, I'm not sure where to go with that. I really haven't framed out my head. Alec Webb in London, I thought was absolutely brilliant yesterday, John, on this NVIDIA AI stuff. What I will say is once we get beyond the debt ceiling, are we this weekend, then we go back to normal interest rate analysis into the June 14th Fed meeting.
So publicly, lawmakers are insulting each other still. The Democrats blaming the Republicans blaming the Democrats. But behind the scenes, according to our reporting, the contours of a deal coming together going into the weekend.
The nuance for you, opening up to the zeitgeist, all the different newspapers and that. I think Greg Valliere takes the high ground today. People are talking about 10 Democrats and that. Valliere says it's 100 of one side and 125 of the other side that need to be convinced. It's a bigger group of people that need to be sold whatever the toxic brew they're doing this weekend.
You count the officials. I'll count the cash at the Treasury right now.
Yeah, please.
Treasury cash balance, latest data, a break of 50 billion. A break of 50 billion, a break below that level. So down from more than 76 billion just the previous day, Tom. So that number's come down. I get that it's lumpy, it can jump, it can fall, but ultimately you can see the trend. 2 weeks ago, from 140 in the middle of May, down towards below 50 billion.
As we get started on this important Friday, I'm going to go idiosyncratic on you. John and I have different launch pads, different screens that we use in the Bloomberg for equities, bonds, currencies, commodities. Out of left field, but I'm sorry, it's a number that sticks out like a sore thumb today. You mentioned South Africa yesterday, unwinding. It's like Dow 10,000, Turkish lira 20. That's a new thing. That's a weaker lira, given the electoral drama that you're seeing in Turkey.
Let's whip through the price action and move on from that. Your equity market more broadly on the S&P 500, negative 0.14% on the S&P. Yields come in just a little bit by about 3 basis points. The 10-year at the moment, about 378.28. A lot of focus on the euro, trying to stage a bounce and recovery. Yes. 107.35. Fact of the matter is, we got down to lows we haven't seen since March recently. Very, very close to breaking 107 in yesterday's session.
I look carefully. We did not break 106 once, twice, 3 times. Maybe today.
Maybe. We'll see if that dollar strength comes through. Bit of economic data coming up a little bit later. Look out for that. We'll get personal income, personal spending at about 8:30 Eastern time. Get a whole load more at about 10 a.m.
I missed that.
UMich sentiment survey coming out before you can enjoy the long weekend. Before we can enjoy the long weekend as well here stateside, Daniel Ricciardo coming up a little bit later. F1 driver Danny Rick.
More
about
than that.
40 minutes away.
To the American audience that may not be familiar with this truly international name, this guy is a star, and it's his character. It's not just driving around. He did the same thing. They all started out at 7 years old. He was near Perth, Australia. He's Australian-Italian?
He is. Speaks Italian too.
Does he speak Italian?
I often thought that he might end up in a seat over at Ferrari, but maybe it's too late for that.
I think there's a lot of speculation about like what's next, but we'll get to that later. But this is going to be fun. This is a guy that's taken the brand further. Imagine that. I mean, he's a little bit like Michael Jordan in basketball. He's done more than just bounce the ball, drive the car.
He's a real personality. He will be the second best guest this hour. The first best joins us now. Bob Dole, CIO at Crossmark Global Investments. Bob, buddy, good to see you. Going into the long weekend, let's start with that rip-roaring rally in big tech and AI. Is that something you're willing to fight right now?
No, not really. Look, into strength, you do trim and trying to buy into weakness. But look, the NVIDIA numbers were off the charts, and that carried the day for technology. My problem is everything else. The average stock year to date is down. The Dow is down year to date. Russell 2000 down. 8 of the 11 sectors down year to date. This is a very narrow and getting narrower market, and that's generally not healthy.
Bob Dole, within your history, do you have an analog? Is there another time that looks like this?
Well, we're not there yet in terms of either valuation or narrowness, but into the 2000 tech peak, there are similarities beginning to build. I hope it doesn't end the way that one did, but we've got to watch it carefully.
Yeah, I look, Bob, at the choices that have to be made, and you're going to make them over a 3-day weekend. You're going to reallocate into June. You're going to reallocate into a mid-year review June 30. How do you reallocate in equities?
So what I've been doing, back to the first question, is into strength, continue to trim tech. And my biggest add in the last quarter has been financials. Those stocks have been decimated. I'm not trying to figure out, which community bank's going to make it, but the big banks that do not have asset liability mismatches, that have good credit, they were taken down big time too. So having added to those, I'm thinking there's more juice to come there.
Bobby, you're talking about some banks like JP Morgan with both the investment bank and a large presence in retail as well. Is it more specific, Morgan Stanley, Goldman Sachs? What names are you thinking about here, Bob?
JP Morgan, top of the list. Citicorp, Bank America, they're the kind of names I'm adding. Already own some Goldman and some Morgan Stanley.
When you look at the community banks, I mean, one thing to do there is an ETF, something like that, the Keefe, Bruyette and Wood Index or so. Do you suggest, instead of cherry-picking community banks, looking at a broad portfolio?
You could do that. Look, I don't think we're out of the woods yet. When the Fed raises rates from 0 to 5% in 13 months, there are consequences. We've seen a few. I suspect the banks are not out of the woods yet, so be careful how fast you go.
Talk to me about preferreds. It's fossils like you and me, Bob. We remember when preferreds were talked about all the time. I think it's much less so now. That extra dividend in preferreds, does it have value?
Yeah, I think it will as we get into, assuming we get into a more defensive environment. We have obviously had a period when both preferreds and yield stocks year to date have not done all that well. That's because we're in an environment where interest rates have moved up. If we can go sidewise for a while and the market, the equity market kind of gets a little sloppy, probably preferreds and dividend yielding stocks do better.
Bob, what would you say to people who have missed out on this rally year to date and are starting to feel anxious about getting in and deploying capital? What's your advice to those people?
Well, first of all, have they really missed the rally? They may have missed the stuff that's up, but the average stock to repeat is down. I wouldn't go chasing a whole lot here. I still think economic weakness, mild recession is in front of us. I know that's a minority of people now, but earnings have not behaved themselves all that well. After a better than expected first quarter, you would have expected a lot of analysts to move their estimates up, and it's been spotty in that sense. And I look at my screen and the stock market selling at 21 times earnings. So it's not like I'm getting a bargain to take on some of this, I really don't know risk.
Are you still advocating for some form of cash position? And if you are, Bob, how big?
Yeah, look, most of my portfolios, I'm to be fully invested. I have some long short portfolios where I do have some cash. When you can get 5% on cash and you're uncertain about earnings and your PE is over 20, having a little cash in your portfolio, whether that's the fixed income portfolio part of your portfolio or the equity part, I don't think is the worst thing in the world.
Hey, Bob, good to catch up. Good to see you. Enjoy the weekend,
Have a
sir.
good weekend.
Bob Dole, thank you, of Crossmark Global Investments. Talking about yield at the moment, 4.49 on a 2-year. Yesterday through 4.50, we had 10 consecutive days of yields rising at the front end of the yield curve. This morning we come back down by about 4 basis points, but let's call it 4.50,
Well,
Tom, again on a 2-year.
I know you're house hunting this weekend, John. 30-year bank rate. I mean, it's a moonshot. I can't count it right now, but it's up 15 days in a row. Let's guess, rounded up 7.15%. And we have just, yes, we've just exceeded the peak of March.
This happened in real time.
In real time. 30-year mortgage, we've just exceeded that peak in March. Mortgage rates are now, based on the bank rate, 30-year mortgage, higher than they were at the March peak.
We've said it how many times? If you got that mortgage 30 years at 3%, you're not letting that go, are you?
This is original. I don't think I can say in any other housing crisis we've seen this.
But I think the whole thing's original right now. Just look at the data that's coming out of manufacturing versus the data coming out of services. The distinction there is just massive. Manufacturing worldwide, Europe, China, US, screaming recession. The services, take a look at airlines. I've had a lot of people reach out to me in the last 24 hours about how busy the airports are going into this weekend. That doesn't look like recession at all.
I talked to my driver today. The Bentley was in the garage, and he said the Hamptons will boom this weekend. He's spending the entire weekend in the Hamptons. He said it's back to 2019.
I'm going to say something that's very foreign to people who live in New York.
Right.
What is it about the Hamptons? What is it about?
I
just don't get it
either.
I don't get it.
No, you're correct.
The beaches are, I'm sure I'm going to offend so many people who have spent a lot of
there's
money on
some nice
houses.
beaches.
They're not that spectacular.
Well, you know, what do you
$100 million
compare him to?
for a house
Excuse me,
on a
guys,
beach.
this is a guy with 4,000 square feet in Capri.
You can go to Capri or Ischia, anywhere on the Amalfi Coast, and pick up a house, a villa, that you can do up for, let's say, several million. Go and have a look at how much it costs to pick up a house in places like Southampton.
I was going to say a
Montauk,
shack.
and we're talking 50 million, 75
John,
million
I can
for
see
what?
you. John, I can see you up the Hudson River, off to the refs.
No, thank you.
My friend Emily's running a grocery
Anyone
store.
who's thinking of doing that, just send me a message. I'll do this for free. I will construct a global property portfolio for you for the same money that you're about to spend 100 million on a place in Montauk. I don't get it.
John, what this could be, instead of Happy Friday, we could say Happy Tuesday. Come back from Memorial Day.
Go to the Jersey Shore. What's wrong with that?
Happy Tuesday.
Happy Tuesday.
Yeah.
Coming up shortly, Jeanette Lowe, a strategist on the debt debate in Washington. That's next.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. And another Republican may be gearing up to enter the 2024 U.S. presidential race. The Wall Street Journal reports North Dakota Governor Doug Burgum is planning an event on June 7th to make a major announcement. Burgum's a wealthy former software entrepreneur who was first elected in 2016. And Bank of Japan Governor Kazuo Ueda says the BOJ's balance sheet isn't necessarily in a normal state, given the bank's large holdings of government bonds and ETFs. Ueda also played down the importance of wages or any single economic data set as a trigger for change. This suggests his desire to hold on to policy flexibility, leaving speculators guessing about the timing of policy shift. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
Speaker McCarthy and I have had several productive conversations. The American people deserve to know that the Social Security payments will be there. The Veterans Hospital will remain open, and that economic progress will be made, and we're going to continue to make it. Default puts all that at risk. Congressional leaders understand that, and they've all agreed there will be no default.
The President of the United States with a touch of happy talk going into the weekend. There will be no default. The latest news, the reality check, just follow the numbers. This from the Treasury cash balance going into the weekend. The cash balance dropping below $50 billion, according to the latest data. That's down from more than $76 billion the day before. The contours of a deal reportedly coming together based on the reporting of Justin Sink and our colleagues down in Washington, D.C. According to people familiar with the matter, the two sides have narrowed some of their differences in recent days. Negotiators, Tom, said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. We're not there yet, but we're getting closer, apparently.
And where are we at, too? And what the conservatives are going to say is, okay, we're there, but just as you said, the key phrase is 2 years, or maybe it's 18 months, maybe it's 3 years, whatever. But it seems like it's almost a collegial Band-Aid to not kick the can down the road, but to have a termination date out there. That's what I'm going to be looking for, is what are the termination dates out there?
Ultimately, the consensus view is, Tom, we'll be doing this at some point further down the road, regardless
well, we've done
of
it 70,
how much further down the road it will be.
I think we've done it 78 times or whatever since World War II. I can't remember the exact statistics. 1960, I believe.
Yeah.
But, you know, we do this every 3 or 4 years, to say the least. As you go into the weekend, 3-day weekend, long weekend for politics in Washington, they will look at policy and the outcomes of it. Joining us now, Jeanette Lowe, Managing Director, Policy Research at Strategas. It is a Baird company. Jeanette, what is the distinction for you? What will you listen for this weekend?
So first, thanks for having me. So we do have a deal coming together, which is good news. There are still a lot of details that need to be worked out as you continue to hear that they've made progress, and they are, limiting the number of issues that still need to be taken into account and finalized among the negotiators. So it does seem like we are getting closer. We're definitely going to be looking at how this deal is structured. This is definitely smaller than what the Republicans initially proposed. They were looking at 10 years of discretionary spending caps. We might be more at 2 years. So how that's going to be structured is going to be important, I think, for the markets, because there is this anticipation that we're going to get some austerity out of this deal. But even if we don't get austerity out of this deal, we still think there's more fiscal austerity in the years ahead for the United States.
This is really, really important. You went right where I wanted to go, and this is literally the history you learned at Richmond and BU. What's the difference between our austerity and what, say, the United Kingdom is living? They seem to be drowning in an austere psychology. I don't see that in the last 8 or 10 years in Washington. I see, if it moves, spend it. Spend every dollar. What's changed?
So what we've seen is that, obviously the pandemic, you had extraordinary fiscal stimulus come into and that the government provided. And then obviously we've had inflation come on top of that. What's really been the key change now, because to your point, we have been able to just spend and cut taxes quite freely for the past number of years. But now that we've had interest rates rise so much, that is now increasing the cost of the U.S. debt. And so net interest costs for the U.S. are now increasing. We have seen historically that once those rates hit 14% of tax revenues, financial markets begin to impose austerity on policymakers. We are currently at 12.7%, and we anticipate that we will get to 14% by the end of the year. And so that is where we're really looking. That's going to start to squeeze the federal budget. So even if this deal is not particularly austere, which given the current contours, it doesn't seem like it will be, we are still looking at the fact that over the next couple of years, the policymakers still have a number of other times that they're going to have to come into play to think about how do they bring the U.S. fiscal budget into a better alignment to kind of handle some of these costs that they're dealing with.
Jeanette, can we just finish on the ex-date, the so-called ex-date? The Treasury doesn't have a precise idea of when that falls. We're all guessing here. They have some information about tax receipts. It can be very lumpy sometimes. How are you reading the tea leaves of that situation?
Right. So, I think all the negotiators want to operate off the fact that we have June 1st as the X date. Now, there always is a little bit of flexibility with that. Treasury wants to have a little bit of a buffer so that if we were to cross over the X date, you would still have maybe some cash to still continue to make payments before the Treasury Department would actually run out of cash. maybe they might be able to make it to June 3rd, maybe not. They did put out an auction this morning that does make it seem like they might have a little bit more cash at the X date. But I think the more important thing is that the negotiators are focused on the X date. And if we were to cross it, we do think that that would be quite a market jolt. It would actually help get a deal if we still hadn't gotten one at the same time. But I think that the actual, loss of cash is less important than that X date right now, just for policymakers to be able to control their focus.
Jeanette, just to finish on that point, when they start to think about prioritising spending, I think there can be some confusion between going through the X date and defaulting on debt obligations. They can be two different things. How do you think the Treasury will start to prioritise spending if we go through that date?
Exactly. It's a great point, because the big thing that we have been trying to focus on is the fact that this would actually not be a default if we crossed over the X date. Treasury, we believe, would prioritize making interest and principal payments on treasuries. This would be more about prioritizing spending and payments to bills that need to go out at some point. We still think that the Treasury would prioritize things like Social Security, Medicare, defense, but then it's about whether or not you pay some other federal contractors on time. So it seems more like what we would see when we have a government shutdown with trying to move payments around, but it's not an actual default on U.S. Treasuries.
Jeanette, thanks for clearing that up. I appreciate it. Fabulous. Just brilliant. Jeanette Lowe there of Strategas. That final point's a really important one.
Yeah.
There have been some conflation between going through the X date and defaulting, Tom. They're not the same thing. They don't have to be the same thing.
I'm really proud of what our team's done on this. Maya McGinnis has been with us, and now Jeanette Lowe. What she said in the middle of that interview, folks, tattoo it to your brain. She said, we're moving from 12% to 14%. And the CBO, this is like the adults, the CBO, forget about the politicians, says in 2053, 38% of our interest expense, 38% of our taxes are going to go to interest payments. That's how out of whack this is. We're trying to get out to June or get out 2 years, as you just said. CBO says we're going to go from 14% of tax revenues to pay the interest bill to 38% in 2053. You and I are going to be on set in 2053. I'm going to be 20 years to that Austrian bond. And the interest math doesn't work.
I'll say this about that. Tom, the problem here is that we're becoming more like Europe, but without the nice trains. It's not pretty. It's not good. And once you get through this, it doesn't mean that the debt conversation goes away. There needs to be a real conversation about this. I think there's been a total failure of those who care about this issue out of power, forgetting about this issue when they come into power. And this is something that, Tom, that quite clearly needs to change based on the trajectory that we're on.
Certainly the recent catalyst was a medical event, a pandemic. Everybody can, look back on history. Books and books will be read. But we had this natural disaster. And now we got to come out and that and get back to the austerity Ms. Lowe was talking about.
And government spending some significant money worldwide off the back of this natural disaster, which makes me wonder, Tom, why there isn't a bigger willingness from governments worldwide to really get to the source of that natural disaster, to understand what was behind it, what happened. I'm still surprised by that today. The almost lack of interest to get to the bottom of that when it's cost global governments so much money responding to it.
I agree, and the question is, how do you prepare for the next disaster? And I don't hear much conversation about that right now.
Very strange, isn't it? A lot of distractions at the moment. Here's one for you. Equity futures on the S&P, negative not even 0.1% on the S&P 500. Great lineup this morning. Dom Constant of Mizuho on this bond market, on the Federal Reserve and the global economy as yields retrace some of the move of the last 10 days after going through 450 on a 2-year. This morning we're down about 5 basis points. Your yield at the moment about 448. From New York City, going into the long weekend, this is Bloomberg. Let's get you to the long weekend stateside. Your equity market on the S&P 500 trying to stage a recovery, just about unchanged on the S&P. Down on the week by about 1% so far this week through Thursday. The Nasdaq slightly positive. The Nasdaq 100 yesterday. Best day of gains so far this month, in the month of May. Even with this in the bond market, 2-year, 10-year, 30-year shaping up as follows. 2-year around 450. We've had 10 consecutive days before today of yields climbing, yields dropping today by 5 basis points. But still, over those 10 days, with yields up something like 50 basis points, call it 60 basis points higher. The Nasdaq 100 is up 4%, more than 4% over the same period. That rate story, Tom, hasn't taken a bite out of the enthusiasm in the equity market.
And the enthusiasm of pretty good GDP numbers, including the second view we saw in first quarter yesterday. John, further inversion now, and I don't know if 70 basis points of inversion's out by near 100 basis points, but the trend's in place. And the real yield, John, the 10-year real yield, 1.53%. That is a change from 7 days ago.
Looking at the nominal yield week to date so far, up something like 22 basis points on the front end in the US. In the UK, we've had a 58 basis point move this week.
Yeah,
at the front end
I'm
of the
glad
yield
you
curve.
mentioned this. Germany, too.
CPI, hot. Pressure on them to hike again. So some really interesting moves in the FX market off the back of some of this too. So let's finish on the euro against the dollar. The euro against the dollar right now at about 107.33. Yesterday coming really, really close to a break of 107 after getting close to breaking 111 not so long ago. Yesterday, the low of the session, Tom, 107.07. Not too far away from talking about 106 going into this weekend.
I mentioned a couple days ago, technically a free fall from 107 to 105. We're not there yet, as we haven't breached 107. It's going to be an extraordinary day. I'm nervous. I'm reading auto. Got Ricardo coming up here.
Very cool.
So we got a bigger superstar than Ricardo coming up right now.
Dom Constant. Are you saying Dom Constant's a bigger guy than?
Yeah, he's huge.
Than Danny Rick.
Yeah, Dominic Constant is.
Do you want the good news today?
Yeah.
Going into the long weekend. No Fed speak. No Fed speak whatsoever from Federal Reserve speakers. They take the day off going into the long weekend.
Yeah, but when Dominic Constant talks, it is Fed speak. He's that influential.
Dom Constant's got to say over at Mizuho on all of this, the Fed speak we've heard so far this week. We still expect the Fed to pause officially in June, and the next move will be a cut. The credit crunch is slowly beginning. And as long as the layoff rate continues to rise, there is scope for a sharp rise in unemployment on the back of lower vacancies. That's certainly not what you saw in claims yesterday, but this is the conversations people are still having, Tom.
There was a conversation 90 days ago, out front 100 days ago, and this was Dominic Constant of Mizuho Americas, certainly lean forward Global Wall Street. And let's get an update right now. Dr. Constant, it's real simple. There's two Americas out there. There's everybody else flat on their back, and there's people that own NVIDIA. They're all out in the Hamptons celebrating this weekend. What does your super restrictive take on the Fed mean for the Hamptons? I'm fascinated by where we are, your super restrictive Fed, and where we're going to be when the first leaves fall in the Hamptons in October.
I think this is kind of the calm before the storm, so to speak. Nothing really has changed over the last few months in terms of the underlying trends of a slowly slowing economy. Basically, you are having credit conditions obviously tightening, and lending growth is slowly slowing. And a number of things in the pipeline, such as when the debt ceiling is passed and a lot of T-bill issuance takes place, that will kind of challenge, if you like, the banks again in terms of potentially losing more deposits. And so I think the idea is just a question of patience. The immediate crisis, whereby in some sense the Fed needed to cut rates, let's say, at the June, July sort of meeting, obviously that's all backed off now. But it doesn't mean that the underlying problems have suddenly sort of gone away. They're still there. And as you say, the real risk is that the unemployment rate rises much more sharply towards the end of the year. And that will have a whole new meaning for the Fed. Right now, they can fight inflation because there's that's the main issue. There's nothing else seems to be a problem. But it will be a problem if unemployment starts to rise faster than most people expect.
What is the rate of change on that? I mean, do you expect, this has been a debate on the show, Dominic, the basic idea of non-farm payrolls, 220, 230, 250,000. Everyone agrees it's coming down. But what do you suggest will be the way it will come down to 40,000, or dare I say a negative non-farm payroll statistic?
Well, the issue really goes back to a debate that the Fed itself had, Governor Waller had with Larry Summers, in terms of you can think about how unemployment rises. It rises either because demand for labor is going away. It can rise also if the supply of labor is going up due to people getting fired or rejoining the labor market. The issue is what happens if both happen at the same time. If people start getting fired and that demand is going away, and the demand is reflected in vacancies. So I think the path, you could see quite a sharp rise in unemployment as those things, two things collide. And those are the very statistics that Governor Waller himself put out in the page paper with Andrew Figueroa in July last year. And they had an example where a 50% jump in layoff rates could lead to unemployment essentially doubling from these levels. So I think the path, if you like, for a quick drop in payrolls around, say, end of Q3, Q4, is certainly plausible. And that, as I said, that would the Fed historically starts to cut rates when unemployment only rises on average 22 basis points. That's for the last 5 cycles. They don't need much of a excuse to start cutting rates if unemployment really starts to rise as much as some of those indicators would suggest.
Isn't it the objective now, though, Dom, to see that happen?
Well, yeah. I mean, that's part of the problem. I mean, inflation is sticky. We all know that. I think most of us sort of understand why it's sticky. I think it's to do more with the supply side rather than demand side. The Fed, it can't be patient really if unemployment's so low. So it kind of needs to see the unemployment rate rise. It's obviously now got the credit tightening on its side for that. And then they can kind of switch gears. But until it does, it doesn't have much incentive to really sort of preempt any kind of loosening up of the labour market while inflation is still sticky. And you mentioned the UK data. I think a lot of people were a bit surprised by that, not just because it was higher than expected, but the goods side was higher. And you saw yesterday Fed officials were talking about concern around goods inflation not perhaps coming down as much as they might have expected in the last couple of months. So those all kind of feed into this sort of nervousness around inflation being still a bit too high. It's got to come down. And, if unemployment's still low, then you just keep on fighting it. And it doesn't mean you keep raising rates, but you certainly have a pause and say, I may have to come back and raise rates again if unemployment's still where it is and inflation is still where it is.
You clearly have a different view on where unemployment is going to go from here. Looking for some pretty soft prints on payrolls. You mentioned vacancies. Can we just talk about that conceptually? Don, we saw a lot of reports, a lot of studies done over the last 6 to 9 months. Some people leaning on this idea that you can have vacancies come down without unemployment going too much higher. What's the reality check to that, Dom?
Well, I mean, the answer is no one really knows. Empirically, it's definitely true that if you go back through cycles, as vacancies come down, unemployment does rise quite a lot. COVID was so amazing in terms of how the labour market restructured. Companies were getting rid of people in one part of the country and rehiring people in another part of the country. The whole efficiency around the job market basically, was temporarily destroyed and has been reshaped. So the truth of it, no one really knows. But there is obviously some good sort of theoretical arguments on the side of the Fed that you could get vacancies coming down quite a lot without necessarily having unemployment go up a lot. And then obviously some people, more people like myself, sort of, we tend to rely perhaps more on historical models and the idea that, if you are going to get a slowdown in vacancies, then the bias would be, the risk is that unemployment just rises a lot more than you think, especially when you have this restrictive policy in place by the Fed. They're not really leaving themselves much wiggle room.
Dominique, you're so cut and chiseled. People don't realize how many years you've been around. Out of Cambridge and Oxford in the 80s, your first day at Credit Suisse, I think it was in the 90s. And it's real simple. I'm looking at the chit-chat we have to put up with every day, from, say, Austin Goolsbee of Chicago over to James Bullard of St. Louis. Are these people talking too much?
Yeah. Well, I mean, yeah, they're certainly talking a lot. I mean, the question is whether it's sort of helpful, I guess, for the markets. I mean, in my mind, it's a lot of noise. I think in general, the governors are good people to listen to. I would sort of, I like, the governors. I think the presidents can be, a little bit sort of, just a lot of sort of a white noise around the whole conversation. Especially if they're not voting, it's much less relevant for markets, obviously. 12
months out, 24 months out, where's the 10-year yield? If we move from a constant super restrictive to something new with a labor deterioration, where's the 10-year end up?
So I think the key thing is really what happens to the supply side, the supply-driven inflation that we're observing is still very high. My guess is a lot of that is still kind of COVID pandemic related, and that will dissipate, especially as you see the labor market normalize. And on that basis, 10-year yields should come down to 3% or below, because the Fed needs to be getting back to the neutral rate, which Williams now confirms isn't very different from what he thought it was before.
There's that headline a couple of days ago.
Dom, I can't let that go.
Yeah.
What did you make of that?
Yeah. But anyway, the risk is obviously stagflation, and that supply inflation doesn't come down. And we've done some, detailed modeling on that, which suggests the 10-year kind of stays where it is. It's like a 3.5–4% kind of yield. It's no big deal, which just means the upside to 10s is probably capped. I mean, you're not going to see a sort of 5–6% yield. Talk about the federal, interest cost. You certainly don't want to see that on a sustained basis.
Hey, Dom, I'm not letting you go without answering. What did you make of that Williams piece?
Well, I mean, I'm not surprised. I mean, I think if you massage your data enough, you're going to get the result you kind of want. My intuition is that he's
Can
probably
you be clearer,
right.
please?
No, I mean, the low era of interest rates, that we saw before the pandemic, it hasn't suddenly changed because of the pandemic, I think. And statistically, obviously he's able to show that by doing some sort of more fancy kind of econometric kind of analysis. Yeah, I mean, we'll see. I sort of my bias is that the low era of interest rates hasn't changed anyway. I think there's a lot of reasons why people are worried about it changing, but I think no one really knows. But I'm happy to run with the flow.
I think the invitation to Jackson Hole just went out the window for Dr. Constant.
Hey, Dominic, thank you. Dominic Constant there from Mizuho. I do know a man who thinks it has changed. Mohammed Al-Arian thinks it may have changed. Going to catch up with him a little bit later this morning.
This debate, folks, from Blanchard to Rogoff, they started it. Everybody's on board. Constant and Al-Arian in the camp with Ken Rogoff.
Coming up, absolute rock star of the F1 grid. Coming up next, Red Bull Racing's Daniel Ricciardo ahead of this weekend's Monaco Grand Prix. That conversation up next.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for up to 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. And Turkey's central bank has kept its benchmark rate on hold at 8.5% for a third month in a bid to stabilize the lira. The policy decision comes ahead of Sunday's runoff election. President Erdogan is looking to extend his 2-decade rule after leading the first round of voting, but failing to take 50% earlier this month. And the cyclone that devastated large parts of New Zealand's North Island in February has been less inflationary than first feared. The RBNZ initially estimated Cyclone Gabrielle would add 0.3 of a percentage point to inflation in the first and second quarters. The central bank has since downgraded that impact to 0.1, saying while it drove up food costs, it didn't affect other goods. Bloomberg has learned that UBS and the Swiss government haven't agreed to the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules as well. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
While inflation is still too high, there are some promising signs of moderation. And I believe that we may be at or near the point where monetary policy can pause raising interest rates, and this will provide an opportunity to more fully assess the impact of the actions we've taken to date.
Well, some good news. That was Susan Collins, the Boston Fed president, by the way. Here's the good news. No Fed speak today.
Yes.
Going into the long weekend. We're kind of done, Tom. We don't have to talk about the Federal Reserve and interest rates anymore.
You know where I stand on this.
All finished up, wrapped up, finished, done. Wonderful.
Done. Announcing Peter Orszag at Lazard. He will take over the reins from Ken Jacobs. This is widely expected. I've known Peter for years. He is a world-class economist out of London School of Economics and brings, John, major policy cred in healthcare toward the Lazard boutique as well. We're going to get to this very quickly because every moment's important in Monaco, and John Farrell's far more abrupt than I am. All I can say is in every sport, there's someone that transcends the day-to-day grind of the sport. You have your heroes. Maybe it's Michael Jordan in basketball. Maybe it's a guy named Judge for the New York Yankees. Daniel Ricciardo is so large for Red Bull and for F1 racing. Anne Hathaway keeled over at the Met Gala when she met him the other day.
I bet she did.
Anne Hathaway fell apart on
We're
meeting
saying
Daniel
here that
Ricciardo.
Hathaway was the fanboy here, not Daniel.
You know, what the problem is, he's wearing Tom Brown at the Met Gala. Thank you, Vogue, for the images. And he puts on a fake bow tie. Can you talk to him, John, when you're in Monaco this weekend? We need Ricciardo in a real bow tie, not a pretend bow tie.
Tied by you. We can talk to him right now. Daniel, I'm pleased to say, joined us going into the race weekend in Monaco. Daniel, wonderful to catch up with you, mate. Just talk to us about how special race weekend is in Monaco.
I thought we were just going to talk about bow ties. Well, all right, let's talk about Monaco. It's, put it this way, I've been coming here now for 13, 14 years, and it doesn't get old. Like that feeling, I don't know, Monaco is just, it's so special. It transforms into this, honestly, like this magical place. For the race, that rhymes. And you have to, I feel like everyone has to experience a Monaco Grand Prix at least once in their life. It's pretty surreal.
Daniel, just to build on that, one theme for us, as we've discussed, Formula One, its explosion in the United States with your boss, Mr. Horner, others as well, is whether we risk losing the heritage of the sport as we expand in places like Vegas, Miami, and elsewhere. How do you feel about that?
I think there always, I think, needs to like remain a place for the, as you say, like the historic venues. Your Monaco's, your, I guess if it's Spa in Belgium or Silverstone, Monza. So these places for me should always have a presence on the calendar. But I also love going to new places. And I think, how we're able to open ourselves up to new markets now and see the growth in the States. For me, I love, because I really enjoy spending time in the States. So having like 3 races there is pretty unreal. So I'm somewhere in the middle where I'm definitely open to having new venues, but I think you still have to keep those core few. They shall always remain.
If we can, I'd love to talk about your future as well. You're a super charismatic guy. Your personality, as I'm sure you're aware, has transcended the sport with what's happened on Netflix and beyond. But Daniel, I know deep down you're a racing driver. And I want to understand from your perspective how frustrating it's been just being on the outside, on the fringes of the sport, being the reserve driver, what it's like being in the simulator, is if it's anywhere near to what it's like actually sitting in the car.
I think this year certainly serves a purpose for me. I did need to kind of, I guess, remove myself a little bit from, literally, I guess, from the driver's seat, just to, in a way, like in simple terms, probably just fall back in love with it again and to really like miss the sport. I'd come off like a more difficult kind of 12, 24 months, like competitive wise. And I was starting just to have too many bad days where I needed a bit of a reset and a refresh. So I'm getting that this year. Sure, it is frustrating to be on the sidelines and to watch, but that's also building like this fire and that desire back. So the plan is to find myself a seat next year. And but I don't want to just be there. I don't want to just get a seat, to say I'm an F1 driver. Right. I certainly want to find my way back to a podium.
Hey, Daniel, you're in the in-between age. I mean, I don't know much about F1 driving, but I've got Alonso making a splash this year at 40-something years old. You got a lot of young Turks following behind you. Tell us the experience value, whether it's Miami or Monaco. What do you sell to a new team or even to Red Bull when you've got a lot more experience? How does that matter in a given race, including this weekend?
Yeah, I think the experience is, I think in this sport as well, a lot of sports, but it's very valuable because, it comes in terms of on driving, on track situations. Of course, the more you can read a situation, then that can obviously help, but also then building a car or helping the guys that build the car and design the car, helping them with feedback and understanding. This helps the team ultimately progress and move forward. So that's the value, I guess, in experience. I'm 33 at the moment. As you mentioned, Alonso, he's in his 40s now, and he's having one of the best years of his career. So that's encouraging for me, because there is days you feel a bit old, but then seeing someone like him, you're like, I feel young again. So
yeah.
It's look, at the end of the day, it's how bad you want it. And look, I'm still in shape, and if I want it, then I believe I'll get back to it.
I'm the ugly American learning about Formula One, and John Farrow's been great about explaining to me the Red Bull distinction. I was comparing them to the West Coast Eagles of Australian football, who are in last place right now. You've been Red Bull since you were like 15 years old, 16. What's the Red Bull pixie dust?
Well, I don't know if that was a jab at me, because I love the Eagles, and yes, they're having an absolutely terrible season. But yeah, Red Bull certainly, they're the opposite right now, and they've been, look, for me growing up, they were the program. That was the franchise, if you will, that everyone wanted to be a part of and sign for. They had all the resources to progress you up the ladder if you were having the results. So that for me is like the family that gave me the opportunity, and now being back in the family, it's like, it feels like it's the biggest family I've ever had in racing, and the place where I feel I belong. So right now, like that's my dream, is to be back here with this team racing and hopefully winning another Monaco one day.
You think there's potential to get a seat again at Red Bull Racing, Daniel, or are you looking elsewhere?
I think, look, in this sport, I know things can change so quickly, and even at the end of 2018, when I moved on to Renault, people probably never ever thought they'd see me wearing a Red Bull polo shirt again. So things certainly change and can happen. So never say never. I'm also just like, look, if I focus on myself and apply myself and keep training, keep working hard, then anything could happen. So yeah, and it helps when you got good looks in this sport. So
of course,
that's what they say.
Like Charles Leclerc. I was just wondering, I know you speak a bit of Italian. You've got that Italian blood running through your veins. Can you imagine being in the red outfit over a Ferrari?
Again, never say never. I feel like it probably would have happened by now, if it would have. So yeah, that one's probably more slim, but honestly, I'd love to be here. That's where I'm at.
That's a nice place to leave it. Daniel, this was a pleasure, a privilege. If you make it to New York, drop by. We'd love to catch up with you. Daniel Ricciardo there.
Yeah, bring Anne Hathaway.
Racing. Of course, bring Anne too. And TK's going to teach you how to do it at the bow tie.
Yeah.
TK, what a legend. What a great guy.
What I would say here, and folks, I'm a complete amateur at this. John's teaching me this stuff as fast as he can. Last race, when Verstappen, a colleague of Mr. Ricciardo's, went by those two cars on like the straightaway, you could just see their cars different. He went by
so
two
much
people,
faster.
Like it was just flew by him.
Looking forward to the race this weekend. The race itself can be a bit of a procession, but qualifying could be pretty interesting.
Well, qualies today start, I believe, like 12 noon or 1:30 our time.
Going into tomorrow.
I mean, start like pretty soon. Excuse me. They start at 1:30 Monaco time. So you and I can be watching the qualies in the 8 o'clock hour.
Practice
They
and
say
then
that
qualifying.
right? Qualies. That's
practice then quali.
Oh, practice and then
Yeah,
quality.
you do practice
Screw
first.
that up. What a
Anyway,
surprise.
from New York, this is Bloomberg.
If you look at tech, it continues to reinvent itself over and over.
People are jumping on the stories that look sustainable.
The big picture here, I think, in terms of the economy, is it continues to expand.
There's no way, in our opinion, that the Fed is going to be easing financial conditions anytime soon.
I think they probably try to hold all year, but then next year start to cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Itching to get to the long weekend, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market just about positive on the S&P 500, up by 0.2% after a day of really decent gains off the back of a monster gain on one stock, specifically, Tom. The AI revolution, the frenzy, it's here.
Yeah, we saw it yesterday. We reviewed it in the last hour. We can go through it lightly right now. And the concentration with this NVIDIA success that you see, if you take, I think it's the top 6 stocks, NASDAQ 100. I'm framing out, John, 28% of the NASDAQ 100. That's outrageous, 32%. That's just out of control. How about 51%?
It's
nuts. Made up of those stocks, and NVIDIA now number 3, out to Facebook.
Go through the numbers. We're up 27% year to date on the NASDAQ 100 right now. And look at the last 10 days before today. Over those 10 sessions, 2-year yields have climbed about 60 basis points. So 10 consecutive days of yields higher. Over the same period, the Nasdaq's up something like more than 4% on the Nasdaq 100. That relationship between bonds and equities that people talk about all the time, that move in yields has not stopped the enthusiasm around the power of some of those names.
The analysis behind that enthusiasm is what is our comfort factor, or how far out we want to go, our terminal value of the profitability of those companies. We were talking retail this week. They make 3 cents on the dollar. They make 6 cents on the dollar. Whoa, they make 12 cents on the dollar. These people are clocking 30 cents on the dollar. Same equivalency, even higher.
And with some stellar growth as well. Potentially
and the potential
coming much sooner than
that's
people
why you
anticipated.
See 30 multiples or 50 multiples as well.
Let's get to the price action right now in the equity market on the S&P 500. Equity futures shaping up as follows, just about positive by 0.2%. We take back some of the move we've seen in the yield curve. On the 10-year, we're down about 3 basis points. I can tell you on the 2-year, we're down about 4. Your 10-year, 378. We'll keep returning to what's been developing in the foreign exchange market. That leg of the stool, 3-leg stool, US, Europe, China. The China leg of the growth stool, Tom, just challenged over the last couple of weeks based on the information that's been incoming. I'd throw Europe into the mix as well. And it's developed into this story where dollar has started to regain some strength and euro dollar's come back from that 111 type level that we were looking at the end of April, back down towards 107.
Pro tip, we're going to be out at Dan Greenhouse's partying on Saturday evening.
Are we invited?
Yes, I think so.
Okay,
if
very
you're
cool.
if you're in China and you're going, the Hamptons, they're all partying like crazy. That's when you act. Are we going to see China? Are we going to see China act this Sunday? Because we're all asleep waiting for Happy Tuesday.
Dan won't be asleep. He joins us now. Dan Greenhouse, Chief Strategist at Solus Alternative Asset Management. Dan, good morning to you.
Good morning to you, sir.
This move in tech, phenomenal. Even with this move in yields, what do you make of that?
Yeah, listen, I think there's clearly a development here in AI, and I don't have anything particularly insightful to say that hasn't been said already. This is another evolution, or appears to be another evolution of the tech space. You had obviously the advent of the internet, the shift to desktop, the shift to cloud, and obviously now this is the next iteration in the development. And I think there is a fair level of enthusiasm that's warranted. Obviously, trading at 30, 40, 50 times sales is always a question, but the argument among growth investors always is that the E or the S, the denominator, is going to be wrong. And ultimately, you're going to be proven right over time.
To me, the study this weekend, seriously, we're making jokes about China. Maybe they'll do something Sunday or not. Is the new thing to study is what does hold mean? If I own these things, I mean, should I buy them? Should I sell them? The character of a hold right now is really opaque. I mean, I don't know what hold means for Apple, hold means for luxury goods, hold means for NVIDIA.
Yeah, listen, I think, again, if you're, we're particularly deep value credit and equity investors. So what we're talking about isn't in particular our wheelhouse, but in a general sense, in the thematic standpoint, for a lot of these names that are developing generational technologies, whether it's NVIDIA or Microsoft with ChatGPT, et cetera, the idea of holding is simply you're going to go up 30%, you're going to go down 50%, you're going to go up 100%. There's going to be volatility, but you're supposed to ride it out because presumably on the other end of it, you're going to realize the gains, a la Amazon in 2000, Apple in 2005, et cetera, et cetera.
These numbers are rough, folks. Don't quote me on these. Greenhouse had them in his note. His note is just chiseled. It's in English. Right now, big cap, large cap up 30%, large energy up 3%. Is energy deep value?
Yeah, I mean, we think so. You mentioned this before, and before we get off of tech, I just want to point it out.
Oh, I'm sorry. I went to energy. I didn't know the script here. Please tell us about tech right now.
You mentioned before about John was talking about how the stock market's up while Treasury yields are up, and obviously there's plenty to talk about in the Treasury market. Sure. But to be clear, these names, the tech names that we're discussing, are driving the gains. And I looked yesterday. The median stock among the FANG or the MAGMA, whatever acronym we want to use, they're up about 35% year to date. The median stock in the remaining 495 is down 2% year to date. There is a tremendous bifurcation in size across cap, whether it's large, mid, or small cap. Larger names are doing better, but particularly in large cap, you have just tremendous outperformance with Tesla and NVIDIA and Meta and the like, and then everybody else is not quite doing as much. And so I think looking at the headline index in general belies some beneath the headline developments even more so right now. But to ramble further on to energy.
Please do.
I think energy presents a lot of value. You've had tremendous developments in the space over the last couple of years that have resulted in even more attractive investment opportunities for several funds willing to step into the space. And what are those? And we know many of them. ESG has scared a lot of investors out of the space. The implosion in energy prices over the last couple of years has resulted in a lot of energy-focused managers stepping away, and that's created some value opportunities for the likes of us. And then at the same time, and you see it right now, the names aren't just derivative plays on oil themselves. Oil itself is off, call it 40% from the high. Broad energy stocks are only down about half of that. Some are down even less because they're much more now a capital return and investment story than it is purely an exploration and production story. And that presents a terrific opportunity for funds such as ours and others to try to exploit some of these dislocations in the market.
Let's unpack some of that then. So the S&P 495, I've heard a lot of people joke about that over the last couple of weeks, and I'm with you. Maybe we should build that, Tom, as an index here at Bloomberg, the S&P 495. And strip out some of those big tech players.
It could be like the Dow Jones Industrial Average.
Yeah. Are we going to market cap weight that?
Yeah.
Yeah. Price weight it. Let's give that a miss. Dan, there are odd things happening, though, in this equity market. We were mentioning offline, and I think it's worth having this conversation online. The home builders since last June are up 70%.
Sure.
Let's just walk through these odd dynamics right now. Elsewhere, you've kind of got like manufacturing in recession, services booming in certain places. We have these broad, generalized conversations about the economy. The economy's doing X, but beneath the surface, you've got like 20 different economies doing radically different things.
Yeah, I think that's right. And admittedly, that's largely true quite often. The best example that comes to mind when you mention that is the 2014-2015 period, when the industrial part of the economy was largely in recession, and we were worried about a broader economic recession that never materialized. But it also speaks to the diversification in a $20 trillion economy that it's really hard to drag the entire thing down into a recession. But to your point about the builders, and I think this is largely the result of the activity post-GFC, which is everybody underbuilt. We knew that as it was happening, and you were set up for a moment in time where if there should be a surge in demand for your product, aka houses, you just wouldn't have the inventory there to meet it. And COVID came along and just absolutely blew the supply-demand metrics as we understood them out of the water. And what you have now is a situation where 95% of homeowners are locked into, call it sub 3% mortgages. So they're not selling and taking on a new 6.5%, 7% mortgage unless they have to. And so you're forced to buy a new home, which is more expensive, but also the result of the builders. And so the builders are excited about this, and ultimately it's driving a lot of the developments that we see in the space.
This gets to the heart of the bigger economic debate at the moment, and that's the recession call. Do you think we face that kind of scenario? Back in 2014, it was very much China-led. Going into 2016, it's basically services going to come down to manufacturing. Do we face a different scenario this time, or is it the same again?
No, listen, I think every recession is a new spin on the roulette wheel. And this actually is a good opportune moment for me to push back on something that people talk about all the time, which I despise.
Please do.
Which is the idea that we've been waiting for this recession for 2 years.
Which you won.
This is nonsense. What happened was when the Fed started raising rates, people were saying, we're going to have a recession probably next year, meaning 2023. At least my view was we're probably going to have a recession in the middle of 2023. That doesn't mean I expected a recession between now, early 22 and 23. It just means when the Fed raises rates, they usually break something and you have a recession. The truth is the recession was supposed to happen around now. It appears that it's not going to be the case. And so now you have your first real instance where you're pushing out your recession call from, call it Q2, Q3 to Q4, Q1.
You're hugely identified with my good friend Carl Keene and others, Scott Wapner over at the Death Star, which is talking about moving things, moving out, doing trades and that. Are people trading too much to create legit alpha?
Probably, but I mean, listen, we know the holding period for equities has been in decline for decades now.
It's Cramer's fault, but other than that,
I don't think we can blame purely Jim Cramer for it. We all bear some responsibility for that development. But listen, I think the research is crystal clear that long-term holdings of value stocks tend to outperform. And obviously there are periods of time that's not the case. And if you look at NVIDIA yesterday.
Where are we right now? Where are we into the end of this year? Is it going to be a trading? Do you need to be supple here? Do you load the boat on an energy stock that's out?
Listen, I think, a lot of people don't have our holding period. We have some names in the portfolio that the PM has held for 10 years, for 12 years. A lot of people don't have that. I've owned Home Depot since 2009. I don't think a lot of people do that anymore. But I think, listen, what you're dealing with now is a quote-unquote expensive market when viewed from the headline. Although another thing I'd like to push back on is the second derivative of that argument is you have a huge expansion in tech stocks, which is going to drag up the whole market's PE. And so it's not as simple as just saying the market is expensive, but you have on its headline an expensive stock market up against the Federal Reserve that is not cutting rates anytime soon and is trying to engineer an economic slowdown. And if the last 60 years of data shows anything, it's that the Fed, generally speaking, gets what it wants.
We should do a segment next time with you, just Dan Greenhouse's pushbacks. 3, 4, 5.
Things with which I have a problem.
Pushback.
Home Depot.
Love that.
Home Depot from 2009 up 23% per year.
It's not bad, is it?
Can we sponsor that segment by anger management?
We should do.
Okay.
We should do. Hey, Dan, this was great. It's good to see you.
Thank you, guys.
Enjoy the weekend. Thank you. Dan Greenhouse there of Solus, Alternative Asset Management from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. Republican and White House negotiators are said to be moving closer to an agreement to raise the U.S. debt ceiling. Sources say the emerging agreement would cap federal spending for 2 years. If a deal is reached soon, a vote in the House of Representatives is likely to take place on Tuesday. Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's weighing on profits. Jacobs will become Lazard's executive chairman. And shares of Marvell Technology are surging in pre-market trading after the chipmaker said it expects sales of AI-related products will at least double this year. Adjusted earnings for the first quarter also beat estimates. It's the latest chipmaker with a rosy forecast on AI. NVIDIA's market value jumped past $930 billion on Thursday. And wealth bankers in Asia at UBS and Credit Suisse will get a rare incentive for bringing in new money. They'll get a cut of the cash, equal to 15 cents for each $100 of new client money. That's according to people familiar with the matter. Asia was once a key battleground for the Swiss rivals, but they're now trying to show clients stability after that emergency merger back in March. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
The reason why we're here We've got more money at any given time coming into our government. But when the Democrats took the majority, they are now spending more than any time in our history, and our debt is higher than any time in our history. So let's just get this right.
It's my understanding that the designees of both President Biden as well as Speaker McCarthy will continue to talk, but it is unfortunate that House Republicans have chosen to get out of town before sundown when we are facing a dangerous default.
House Speaker Kevin McCarthy, House Minority Leader Hakeem Jeffries. The back and forth, the blame game continues in Washington, D.C. Publicly, privately behind the scenes, the contour of a deal might be coming together. We'll talk about the details of that in just a moment. Welcome to the programme. In the equity market, S&P 500 futures are positive by 0.2%. Big gains yesterday on the S&P. Big gains on the Nasdaq off the back of that monster move in Nvidia. The Nasdaq 100 had its best day of gains so far for the month of May. As we move towards the end of the month of May, yields have been on the climb over the last 10 days, that's for sure. Today, a break. Yields are lower by 3 basis points to 378 at the front end where the bulk of the move has been. We're down 3 or 4 basis points on a 2-year to about 450. Worth reflecting on this, though. I feel like we haven't talked about it much. The 2-year versus the 10-year. That curve, Tom, back to negative 70. Something. Negative 70 right now.
Let's go up Priya Mizran. You're going to do this right now with someone who made a great call here. This is a vanilla spread, the difference between the 2-year and the 10-year yield. And John, any kind of inversion's a big deal. Oh, it signals recession and all that. And Priya came out and said, hey, we're going to 60 basis points, 0.60% between the 2-year and the 10-year. We said, you're nuts, Priya. Then she recalibrated to 80 or 100 basis points with Ira Jersey. We got there. We pulled back. And this week, we're coming back down again, a greater inversion.
Well, forgive the bond market jargon, but ultimately what happened, what started to develop was that classic bull steepener, which effectively means the front end of the yield curve starts to drop, the 2-year starts to rally, anticipating a rate-cutting cycle. And what we've done over the last couple of weeks is take some of that back, take a lot of it back. We've priced out rate cuts and started to price in rate hikes off the back of Fed speak, which has encouraged that stance. There's been a persistent effort, I think, from Federal Reserve speakers, regardless of whether they think hike or pause, but ultimately no cuts, 1. And 2, it's been validated and supported by the incoming information. Whether you look at the economic data, where you look at the economic data, look to claims yesterday. Claims yesterday adjusted off the back of that Massachusetts story and the fraud, and we've got to take some of that out. And we're coming down. We're not going up. That's been a change.
I agree. And Dominic Constant on earlier, that was sobering, what he says here. It's going to happen quickly. It's going to be in the autumn and into the winter as well. What we know for certain is she's in Washington. Anne-Marie Horton is our Long Island hot dog correspondent here on Memorial Day. She knows famous Charlie's Hot Dogs is a place to be Memorial Day weekend on her Long Island. They're going to be barbecuing. There's going to be hot dogs, hamburgers, for key players in the debt debate, and just as importantly, for those listening to their constituents. Anne-Marie, this long weekend, what are the constituents saying to the politicians of our debt crisis?
Well, I think that's one potential issue that these negotiators will be dealing with, if that you have some of these members, either whether very progressive or very right-wing, that they need to make sure that they're going to get enough votes to pass this negotiation, which we're starting to get more details of this debt limit bill. Can they be emboldened when they come back, and does that change how they vote?
Yeah.
Because remember, Speaker McCarthy has told the House that they will have 72 hours for any legislation to read it. So if we were to get an agreement today and they have 72 hours, they have their entire Memorial Day weekend, whether having a hot dog or a lobster roll. By the way, we'll talk about John's rudeness about the Hamptons a little bit later. But will they come back emboldened? And would they want to potentially ask for more, whether it's pushing back on the White House, if you're progressive and not liking some of the caves they had to make, or if you're part of McCarthy's caucus and you already voted for a bill and you liked some of those deep spending cuts, is this going to be too easy and you're going to want to see more?
Yeah, I look, Anne-Marie, at the idea of coming back, and I think there's been a media frenzy, no fault of anyone's, to look at 5, 6, 8 people. Greg Valliere this morning makes it really clear this isn't about a debate of 5 or 6 or 10 people. It's 100 on one side and maybe 100 Democrats on the other side. There's a lot of people here to play with to get to an agreement. Am I right on that?
That's exactly right. To actually get the deal through, there needs to be votes on either side of the aisle, which is why, as you look at some of the contours of the details coming through, you can see where there are wins for the left and the right. The issue, though, and Joe and I have been speaking to lawmakers every evening on balance of power, and last night, the latest was Representative Seth Moulton. I said, what are you hearing? What's in the agreement? And he says, I don't really know right now. They have been keeping this very much so in a small circle in terms of hammering out the negotiations and really under cloak and daggers before they release this text. And then they're going to have to start whipping the votes. If they get it through the House, a big issue could potentially be the Senate, because one senator has a ton of power to really gum up the works and make this very long, difficult, and cumbersome. And that could be difficult if we're approaching, obviously, less than a week, the June 1st deadline, where the Treasury Secretary says they can run out of cash as soon as that date. And already what we saw from Senator Mike Lee of Utah yesterday is he says if there's not substantial spending cuts, I'm going to make it difficult to get this passed in the Senate. And that's where you're going to have, Leader Mitch McConnell really have to come and make sure he can get the Republicans in line to get this over the finish line. It's going to be difficult, though.
You mentioned a couple of names. Going into the weekend, then, if we manage to get some contours of a deal, an agreement, a framework, whatever it might be, who are the names to watch, Anne-Marie, beyond this weekend?
Well, I think some of the names to watch is the group, the Freedom Caucus, like Chip Roy of Texas on the House side. That group has already sent McCarthy a letter saying, please hold firm on the deep spending cuts. And then in the Senate side, it's really the likes of Senator Mike Lee of Utah, also Senator Ron Paul. These individuals we have seen try to use the filibuster, try to not make it easy for Senator Schumer to get something through very quickly. So even if they're able to come up with a deal, that is really the first part of the hurdle of getting this over the finish line. It's a positive step. Goldman Sachs' Alec Phillips and Jan Hatzius are saying they could see this happening today, which means we could see a vote as early as Tuesday in the House. But it's not smooth sailing.
OK, the floor is yours. We have the time.
Anne-Marie, this is real simple.
She wants to have a rant about the Hamptons. Give her a chance.
Anne-Marie, educate young Ferro here on the lobster roll at lunch.
Exactly.
I mean, if you're going to go to lunch and have the lobster roll, first of all, it's going to cost you $60, John.
Right.
To have a lobster roll. Go, Anne-Marie. Lobster roll.
It is quintessential. Also, if you have celiac disease or any other dietary issues, they do a lobster roll on a gluten-free bun. It's a must-stop of the summer. And John clearly has not been, because if he has been, he would not be sitting here and just ragging on the Hamptons.
John has been.
He needs a weekend out there.
Believe me, John has been.
Take him out.
John has done a Memorial Day weekend in the Hamptons. Saw the price at the end of it and decided we won't be doing that again. AMH, thank you. Anne-Marie Hordern, down in Washington, D.C., wishing she was somewhere else, clearly, based on how that conversation went.
It's going to be a remote from the lobster roll. It's a sign, John. It says a lobster roll, and above it says lunch.
I do love a lobster roll.
And nobody calls it the lobster roll. They call it lunch.
I do love a lobster roll. Let's put it that way. I do love that.
They were more consistent years ago. Now everybody's trying to do their own little thing, so you really never know what you're getting when you walk.
Usually I order an extra bun because you get so much lobster here in the roll.
Yeah, I agree with that. But the big thing is it warm or cold? Is the first order condition.
Oh, toasted bun.
Toasted bun,
yeah, it's
but
got to be
then
a toasted
cold
bun.
Lobster, or do you do the hot butter thing?
No, I don't mind a cold lobster in that. No,
my answer is if someone hands me one, I say thank you.
I would say thank you.
Thank you. That's very good.
This weekend, though, all about sport. Monaco, Formula One.
Oh, seriously.
Juventus, AC Milan.
The Colonial.
The golf is on.
Yeah.
Very cool.
Michael Block, last place.
We've got the playoff for the Premier League place for promotion.
And Coventry City. I mean, nothing. I mean, we should have asked Ricardo about Coventry City.
We should have asked. I'm sure he would have had a lot to say from New York. This is Bloomberg. Equities up, going into the weekend. The opening bell about 2 hours away. Your equity market shaping up as follows. On the S&P 500, positive 0.2%. On the Nasdaq 100, positive another 0.4%. We just add some more weight to this rally. Year to date, the Nasdaq 100 up 27% and some. You can thank a couple of names for that. Meta, You can thank NVIDIA. NVIDIA flying yesterday, just remarkable stuff. We're talking about $150, $200 billion of market cap in a single session on a single name. In the bond market, this has been happening despite this move, with a 2-year back at 450, 449.
That is the story of the week. All the rest, it's been a crazy
10 days,
week.
60 basis point move.
Story.
10 days, 60 basis point move. Equity market not feeling it. FX market is feeling it. So check out the euro. Very close to breaking 107 in yesterday's session. 107.45 right now. Trying to bounce. We're positive there by 0.2%. That's a stronger euro in the mix, but it's been about a stronger dollar. It's been about basically beating up consensus positions. Coming into the year, one big consensus position was just, I don't like tech, because tech didn't work last year. Well, tech's worked this year. So that was consensus position 1, taken out. Consensus position 2 was to get short the US dollar because Europe and the rest of the world, China's reopening is going to be great. Last month, that has been challenged.
Done.
Rate cut story, that's been challenged. What's left?
Done.
What's left?
I think what's left is this imbalance that Dan Greenhouse was talking about. And every day after NVIDIA yesterday, it is this word doesn't work, but it does work. Historic. It's absolutely historic where we are now. This is not 2001, and on and on and on.
So here's my question now, Tom, and I wonder how you think about this at the moment. Give it some thought. Spent a long time talking about U.S. equity market exceptionalism, because in the United States you had Google, you had Facebook, you had Amazon, you had Netflix, you had others as well, and those names were not in Europe. And that's why we saw this big outperformance at the index level on the S&P 500. And now we're talking about names like NVIDIA, the AI revolution. And when we talk about this, again, we are talking about U.S. companies listed on the U.S. equity market. Where do you stand now on this idea of U.S. exceptionalism, just as people were starting to think about Europe and China all over again?
This is really important. We don't have time for it right now. This will be a theme for us next week, I promise. This is really important. The distinction is profit. These companies are minting money, and even companies less successful are making profit versus the silliness we saw in 2001. There's a massive, massive distinction here of they're profitable. Now, the growth may go away, and the 30 multiple may crash down to 23 multiple, doom and gloom. But the fact is, they're still minting money on a quarter-to-quarter
You're
basis.
right, Tom, because when we talk about PEs, at least we're talking about PE, because there's some earnings there. And if you go back 23 years, that wasn't really the story in many places.
And frankly, other years like the crisis in 1998 had a little bit to do with losing money as well. Someone with historical perspective on that. This is really special, folks, on Memorial Day. It's a terrific show. The team did not mail it in. They're not saying Happy Tuesday. Either is James Kemp. He is a student of the markets with decades of experience at Eagle Asset Management down to the south side, and we welcome him this morning. James, I'm looking at the Bloomberg Total Return Index. You and I still call it the Lehman Index. Mike gets upset with me when I do that. But the bottom line is you and I had a bear market in bonds priced down that we never imagined. We've barely come back. And just in the last number of days with this new high yield, we're rolling over again. When did bonds recover to the glory that we knew 3 years ago?
Well, good morning, and thank you for having me this morning. I think it's close. And the reason that I say that is if you go back historically, I've been through 5 tightening cycles. And every time we get a tightening cycle or beginning of a peaking process from the Fed, the subsequent returns to the bond market 1, 3, and 5 are unambiguously good. And I think what's happening now is these short-term yields are attracting a lot of capital. We see it. The flows are extraordinary. Into the money complex. When folks wake up and realize that they can lock in north of 5% yields for the next decade plus, I think we're going to start to see the flows come back into the bond market. Suspect that we get a peaking in 10-year early summer because of some inflationary base effects, but we're pretty close to a strong buy in the bond market right now.
Are you predicting that we will see an inflation-adjusted return on yield, that we will see a constructive real yield environment like you and I remember in our youth?
Yes, I think we will, because I think inflation is trending down pretty significantly. I think the Fed's making a mistake being dogmatic about 2%. I think they're going to have to relax that. But still, a high-grade corporate credit, we can get 6.25%. Municipals on a taxable equivalent basis approaching those levels. Those are real returns and real yields. And historically, they're starting to compete with equity-like returns over the long term. So it's a good time to own duration.
Let's not bury the lead. Let's sit on it. We get the notes from the team here when we get a guest like James on, and I'm reading the notes right now. Recession likely starts in Q4 2024, James. Not 2023,
John,
2024.
Yeah, I apologize. That's a Q4 2023, Q1 2024 type
your
phenomenon.
notes are wrong. James, okay, good, because I was getting all excited about where's this extra 18 months coming from. James, walk us through the actual view.
Well, and so what I think happens is we inverted back in October, November. We typically have a 300-day lag. The other part of the equation is with the banking situation, credit conditions are tightening very rapidly. So you have the monetary side pushing rates up. You have the credit conditions getting tighter. Banks aren't going to lend when they're trying to mark their books and they don't know what deposit flight really looks like. They're getting a grip on it, I think, now. So the tenor of the recession sort of lines up on the calendar as a Q4, Q1 type phenomena. And some of the data we're seeing out of labor is suggestive of that. Look, we had a recession last year. We're going to have an earnings recession. These are not, I think, as Tom was alluding to, and you're talking about AI and the like, recessions aren't bad things. They reorder capital. They reorder the industry. Companies now with cost of capital is higher, got to look to productivity, which is the lifeblood of growth given a struggling demographic. This ultimately gets us to a better place. It's just going to be choppy from here to the end of the year.
Well, James, let's relax a bit and kick back and maybe talk a little bit more loosely. I don't care about this word recession so much. I don't care about a group of individuals getting together at MBR and saying that was it happened. I want to understand from your perspective where you think that weakness is going to emerge. Because at the moment, I can tell you, manufacturing's in one, services is not. I can tell you at the moment, home building certainly not in one based on the stock price performance since the last June, with that particular part of the equity market up something like 70%. AI's not in one, absolutely loving it, massive tailwind, tons of enthusiasm. Where are you seeing the actual concentrated economic weakness?
But you talk about the service sector. If you look at things like open table data, it's starting to roll over. You're seeing some pullback in consumption. As mentioned earlier, real wages, even though nominal wages are higher, real wages are actually negative year over year. Credit borrowings, credit leverage, et cetera, is picking back up. The key to all of this is going to be what cracks in the labor market. And this is what the Fed is dogmatic about. Going back to that 2% rate, the only way you get 2% inflation is with a recession and with the labor market rolling over. And I think that's kind of where they're pushing. The other thing that you mentioned in terms of where the market is sort of getting buoyed a little bit is housing. We always get a bump in housing. We always get sort of a little bounce pre-recession. Let's see if housing follows through on that or if housing rolls over a little bit. We know that we have a lack of capacity. We have a lack of supply all the way back to the great financial crisis in housing. So that is a bright spot. I just don't know how big the legs are there. We'll have to watch that.
James, I look at, and I really want to dovetail this into all your work. And I mean, you're bringing Vanderbilt Engineering here, so you certainly get the dynamics. All people want to know is, can they clip a coupon and someday get a total return? How far are we from the world of Bill Gross, of Dan Fuss and other bond giants, where you clip a coupon and you get some gain?
Well, let's remember the 10-year Treasury was 40 basis points 3 years ago. When it sits at 380, that's a massive
Yeah, I agree.
move.
It's unusual. Yeah.
And the S&P now is got a yield of about 170. So the script has been flipped, stocks, bonds, and clipping a coupon now is absolutely in the current offerings. And I think what people have to understand is, these yields, if we do have a recession, if the Fed does at some point have to relax these short-term interest rates, you're going to have a much better return profile and income profile by locking up long-duration assets. It's counterintuitive when a yield curve is upside down and inverted, but it is historically everywhere and every time the right trade for individuals.
What about competition from equities? I mean, I get that the tech place is on fire, but it's just so simplistic to say the yield is now better than the dividend because I got dividend growth as well. When do equities compete again?
Yeah, and that's a great point. In our programs, we also use the equity side pretty aggressively. That includes, companies that are paying above market, but have that growth. And that's the essence of it. You've got to have quality. You've got to have pricing power. You want to compound that dividend over time. You don't want to simply take current yield. So those two asset classes, for the first time, 2022 was tough, obviously, for a lot of reasons, but the correlations were positive. So even if you had a balanced approach, you had a negative total return across the board. You use both of those asset classes in concert to make sure that you're getting the optimal yield. Right now, we're leaning more into the bond side because we think that's first to recover. That's first to produce better than market returns relative to dividend equity. But that's and remember, Tom, and you know this, dividend equity is lagging now, right? If you separate the S&P constituents and you look at payers, non-payers, those handful of stocks that are leading that are not income producing for clients are the market story. So even though the dividend is there and the dividend is growing from a return standpoint, it has lagged bonds year to date.
Hey, James, this was great. Enjoy the long weekend. It's good to catch up. James Camp there of Eagle Asset Management. How many messages are you getting about lobster rolls now?
Oh, it's off the chart.
It's ridiculous.
I mean,
do you think anywhere in New York...
We didn't ask Daniel Ricciardo about lobster
Could we get
rolls.
one for breakfast? Because now I'm craving one.
I have to admit, I have to.
Luke's Lobster opens up at 11 a.m. Eastern time, I think. So you've got a couple of hours to wait for that.
Or down at Chelsea Market, there's one I go to there that's
what's that?
spectacular. I can't remember the name of it, but it's like Lobster House or whatever. And they've got one side restaurant where you sit and you're responsible. And the other one is you sit on stools if you can find one because it's packed all the time. And what I do there, seriously, folks, this is wonderful. Chelsea Market in New York, this is what it's about. First of all, their business is so huge that everything's fresh. That's the first thing. And in America, John, it's not often the case. And there'll always be one thing I've never seen before, and I will try it. Usually I hate it.
What's that?
But
Give us an example.
It was like something you step on in the Philippines. You go to Palawan and, you're out there and you put your foot on something.
Just be careful. There's a wife at home,
Yeah,
your wife,
but,
who's not going to be too happy with that comment.
I'll try it to keep the marriage together.
Okay.
And it's usually I go down in flames, but at least I try it as well as your basic Maine lobster.
Mrs. Keene watching right now.
Can we get Gerard Cassidy on? We need an authority on this.
Up in Maine.
Yeah.
Proper lobster. Coming up next, Dan Ives of Wedbush on AI and tech. Your equity market positive, 0.2% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from budget increase for the IRS. And another Republican may be gearing up to enter the 2024 U.S. presidential race. The Wall Street Journal reports North Dakota Governor Doug Burgum is planning an event on June 7th to make a major announcement. Burgum's a wealthy former software entrepreneur who was first elected in 2016. And economists now think China's central bank will cut the reserve requirement ratio for major banks by 25 basis points before the end of the third quarter. That's earlier than they previously anticipated. This comes from Bloomberg's latest survey. They also pared expectations for GDP to 5.5%. And Cathie Wood's flagship ETF closed out its Nvidia stake in January, missing out on the stock's recent powerful rally. The chipmaker, the world's most valuable, has added more than $500 billion in market cap since Wood dumped the shares. Wood holds Nvidia across several of her smaller funds, but investors in the flagship ARK Innovation ETF missed out on Nvidia's blistering rally. And Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's weighing on profits. Jacobs will become Lazard's executive chairman. Global news powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
If you look at tech, it continues to reinvent itself over and over. The latest generation is going to be AI. And I think as you look at the visibility of earnings, you continue to see a strong earnings coming. And I think that that's important because a lot of people continue to say that tech has gotten expensive. But when you start to factor in how much tech has been able to beat their earnings, I don't think it's as expensive as what people think. And I think that trend is going to continue.
Really nice to hear from Larry Adam to catch up with the Chief Investment Officer at Raymond James. He's constructive, has good reason to be. Year to date, absolutely flying on some of those names. Someone reached out on Twitter, Tom, just that. restaurant you were talking about over in Chelsea Market.
Yes, yeah.
Cullen Pistol.
Surveillance correction,
Pistol.
folks. Before David Weston emailed in watching this morning. David Weston said,
What did Weston
"Tom,"
say?
He said, Tom, it's not called a lobster place. Weston's there like 3 days a week.
Oh, he goes to Cullen Pistol.
Yeah, he goes to Cullen Pistol. And thank you so much on Twitter. I had a brain freeze. What
I've
can I
never
say?
been. It looks pretty nice,
Oh,
to be
no,
honest with
it's
you.
spectacular. I can't say enough about it. Fresh. It's like...
I've got a brunch spot that does lobster and scrambled eggs. I'm not going to
Mhm.
share it because at the moment it's quiet and I kind of like it that way.
You get it with the smashed peas?
No, just have it as it is. Just like that. It's perfect.
Cullen
I'm enjoying
Pistol.
it right now.
It's really, really good.
Dan Ives with us in the studio of Wedbush, weighing in on NVIDIA's surge. He wrote recently the following. In 22 years of covering tech stocks and large cap, we have never capitalized, seen a guidance range of this magnitude on a large cap tech name, and thus speaks to our thesis that the monetization of AI for stalwarts like Microsoft, Alphabet, Amazon, Oracle, Meta, Apple, and Salesforce, Tom, is well underway in this Game of Thrones battle among tech players.
This is the interview of the day. There's no question about it. You know, he's competing with Daniel Ricciardo of Formula One fame, and Bob Dole was on earlier, and a bunch of other worthies. This is what matters, folks, because you're living the tech dream like we are, and Mr. Ives is leading the way with optimism on their profitability, their enduring profitability. He is at Wedbush Securities. In Cupertino yesterday, they saw what you saw. What does the NVIDIA 4.4 standard deviation leap mean for Alphabet? And particularly, what's it mean for Apple?
Look, I mean, this, in my opinion, it's $800 billion of incremental spend now over the next decade for big tech. And when you look specifically at the read-through for Apple, I mean, there's no better read-through, what I believe, and we'll see more at the developer conference, in terms of overall demand. And this AI revolution, it's opening up a total addressable market for these big tech players that wasn't there 6 months ago.
Is it profitable, Ad? That's at the top of the income statement. That's CapEx off cash flow. But will it be profitable?
It is a gold mine in terms of profitability from a margin perspective, because that's right now Nadella and Redmond, I mean, they're popping the champagne because for every dollar that you're going to see of AI spend, that's margin incremental 15%. Incremental margin. So I think what's starting to happen with these stocks is that Street's starting to look through the trajectory. You're looking at higher margin business, growth that's really going to be, you could really count in two hands the amount of players that are going to benefit on the first, second derivative. And when you saw it from NVIDIA, it shows this is a gold rush that's real, not hype theme, maybe like metaverse, you know, in crypto and some of the others.
So we're going into the long weekend, and there's going to be a bunch of family members of people who follow this stuff, maybe even buy it, who are going to hear of this company for the first time. It's been performing really well for a long time, but for a lot of other people, they might not be familiar with this name. It's not exactly a household name outside of Wall Street. Can you run people through what they actually do and what they're leveraging here?
So when you think NVIDIA, in my opinion, I view it as the hearts and lungs, the epicenter of really, from a chip perspective, of AI and what I'll call big data technology. Nothing works without NVIDIA chips. Microsoft, Google, Amazon, it's all feeding off NVIDIA. And that's why I kind of view as the foundation, the best derivative in terms of what you see as a forecast, what's coming down the pike 3, 6, 9 months from now, is what you saw from Jensen with the $4 billion guidance rates. Because that now is going to feed into Microsoft, it's going to feed into big tech. And I think, you know, in my opinion, it's not just about the guidance. This is a historic day that shows the AI revolution. I believe it's probably the biggest transformational tech trend I've seen since covering tech in the late 90s.
That's a lot of hyperbolic language. So let's strip some of that down and talk about valuations. When it comes to momentum in names like this, how relevant are valuation metrics, given the story that you're describing and this big future that you're expecting?
I think when you become laser focused on valuation over the next year, you would have missed basically every transformational tech stock the last 15 years. So in my opinion, to look at that, it's looking at the leaves instead of forest through the trees. But I look at it like you could look at an incremental $5, $10 per share of earnings power when you start to trajectory it out. You know, as Tom and I have talked, you know, on Apple, I mean, I view Apple right now in some of the parts. I could argue that AI adds another $30 to $40 per share to the Apple story.
What's Apple doing with AI? What's that about?
Well, I think we're going to see the developer conference, because ultimately they're going to really, right now, the billions they've been spending on AI, it's going to be another use case that you're going to be able to deploy within their install base, within those 2 billion iPhones.
But what are we talking about? Siri on steroids? What are you describing here?
So from an AI perspective, they're really going to be, from a user perspective, be giving users the ability to, on the services side, from cloud, from music, from TV, to more and more of the devices, cross-pollinating between different devices, that you're going to be able to get different information within the actual Apple user. And I think what Cook's going to talk about is AI could be really another foundation, another monetization of the Cupertino growth story.
You're the Uber Bowl. You got a lot of people taking shots at you. And any research report, halfway through, there's 3 paragraphs on total risks. What's the lead total risk paragraph to AI?
Biggest risk is basically what I view as the U.S.-China decoupling, because you could argue that that's a risk from an AI perspective. And two,
is Taiwan a risk because this stuff is actually made off TSMC?
I mean, look, I was just in Taiwan a week and a half ago. I think right now it's bark worse than bite, in my opinion, in terms of as an overall risk. Biggest risk is just companies don't spend. They had to hype the economy. Ultimately, they're going to. But as of right now, what we're seeing is, I think this is right now a green light to own tech, in terms of what we view. And I think this is just, I think the start of it, I think tech's being up another 10, 15% rest of the year.
Apple EBITDA margin, 32 cents on the dollar. What does AI do to that out 5 years?
That basically increased it by about 500 bips.
So what is it? Some of the parts, did you say up $20?
Some of the part, you can say Apple, it could add $30 to $40 per share as it all gets monetized into the base.
It's amazing, isn't it? It's easy,
I've never heard this.
Easy to sit here and just be smug. I reflected on this a couple of times in the last few years, and once more recently. There's this great exchange, Dan, and I'm sure you've seen it, between an analyst on Wall Street, bullish on the internet, and a journalist from 60 Minutes. And the journalist from 60 Minutes is sitting with this analyst on Wall Street and saying, Amazon's worth more than Sears? Does that make sense? And he's so convinced he's right about Amazon just being this bubble and Sears being, what Sears was. And I'm just trying as hard as I can to be open-minded about this moment at the moment, Dan. Any reflections on this period and that one?
I mean, this period reminds me of what I viewed coming out of the Apple launch with Jobs in 2007. Right. And it reminds me of my visits with e-commerce companies in the late 90s in terms of, so I would say there's only 2 other times that I would compare to this. And I believe that's why Nadella, that's why Cook, that's why Jensen are going after AI.
Your buy recommendations built half the houses in the Hamptons. I mean, anything over 5,000 square feet, they got a brass plaque on it. Thank you, Dan, as well. Would you like to weigh in on the lobster roll debate in the Hamptons here? I mean, you've got a little bit of experience at that.
I do. I'm super bullish on the lobster roll in Hamptons, but I continue to believe the best lobster rolls are a 617 area code.
So up in Boston, you like it with the hot butter or the cold?
I do. Look, and even though I'm a Long Island guy, I'm more of a 617 when it comes to lobster rolls.
John has no idea what we're talking. I mean, you don't have to go to Maine to get the proper New England roll.
I've had lobster in Boston. I'm very well traveled. Thank you.
But I will say Ferro at Durgan Parks years ago. Could you imagine what the waitress would do to John Ferro at Durgan? Your accent, who are you?
But the guy's a legend. It doesn't matter where the lobster
Thank you, Dan.
roll
You
place is.
tell him. You clear that up. I just got this message from Art Vanderlei on Twitter, and thank you for writing in, because a lot of you have given us recommendations.
Oh, are we
now
getting
for
recommendations?
Lobster Landing in Clinton, Connecticut.
Oh, yes.
Lobster Landing.
Yes.
Looks like this little shack by the water. It looks fantastic.
Jonathan emails in Surf Avenue, Coney Island. I'm actually down there a couple times a year. Afterthought forces me to go down. Nathan's. There it is, 11224.
Go for it,
And
Dan.
there's some
Seconds.
under the radar lobster roll places in Hampton Bays, not in the core Hamptons. Some places are a little off the grid out there.
You write a research report on this?
I could, and maybe
Probably expense the whole thing.
And maybe a ChatGPT angle as well.
Very cool. Let's make that happen.
ChatGPT
Hey, Dan, it's good to see you.
lobster
Dan Ives
roll.
of Wedbush. Going into the weekend with some of these names ripping. Mike Wilson, Morgan Stanley, with a different perspective on this equity market. That conversation coming up shortly. Looking forward to that. From New York City this morning, good morning. Equities higher.
always flying blind in this economy.
If you look at the performance in U.S. equities, I think there's a huge amount of dispersion within that.
I still like the equity markets longer term for people that have a long-term horizon.
You cannot be underweight stocks here.
This is pretty classic late cycle behavior.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bramo off today. It's like a three-island tour for the Memorial Day. Having lobster rolls at all three islands as well. We're having fun today, but as we said on Wednesday, you know what? There's some real news flow going on. On a cautious view on the market, Michael Wilson will join us from Morgan Stanley here in a moment. And John, pushing against Wilson is NVIDIA yesterday. And just moments ago, futures up 11 as well.
Well, it depends how you slice and dice the equity market. Dan Greenhouse of Solus was sitting just over there next to you in the last hour, and he talked about the S&P 495. The S&P 500 doing its thing, the Nasdaq 100 doing its thing. But when you take away the big players, Tom, underneath the surface, there's a bit of a struggle. I think we're going into this long weekend stateside, and there's going to be some conversations around the table with the family about perhaps the fear of missing out as the AI revolution starts to take hold. Michael Hartnett of BofA does a great note weekly on a Friday, and he talks about the zeitgeist of the moment. He said if you're going to lose your job and be replaced by AI in the next few years, might as well own some AI as a hedge, no? And that's kind of the zeitgeist of the moment, according to Michael.
In my take, there's a little bit of silliness going on here, and I can't identify what's the silly part and what's the genuine part.
Agreed.
But my part is Ives was just sitting here, and he's like a piñata. The hate mail on Dan Ives is tangible. The fact is he's enjoyed Apple from 100 to 170. And the point here is profitability. I don't hear anybody saying this will be non-profitable.
I want to make it even more simple. The point for me is use case. I want to understand, Tom, when people talk about Apple and AI,
I'm not there.
What's the use case? I'm trying to understand
I don't get it.
Dan did his best at explaining it. I wasn't quite there.
Nope.
I'm doing my best to stay open-minded about it. If it is this big revolution, then I think we need to be. But when we start to make stock selection calls off the back of this story, I want to understand use case.
I would suggest, does it embed revenue growth and does it come down the income statement? But the real question is, does it roll over to the rest of the American economy, increase productivity? And that's the separation in equity markets we're going to talk to Mike Wilson about in a moment. Mike Wilson is riveted on Zevis and the policy people at Morgan Stanley and Washington. A sleepless weekend for Morgan Stanley policy.
Do you think there's actually going to be a sleepless weekend anywhere down into D.C.? And there's debt ceiling debacle?
No.
The
It's not a
contours of a
toxic
deal
brew.
coming together?
It's a ballet the president knows well. The thing here, and this is not about the politics, Democrat and Republican. It's about we got a president who's been through this, 20 times?
Yeah, plus. He's been around a long time, hasn't he?
Yeah.
Seen it a few
That's
times.
weird. Data. Futures up 11. They've turned here moments ago. I got a VIX 18.73.
I've got the S&P up 0.25% on the S&P 500 futures with a lift. Yields dropping back, down 3 basis points. Around 380, though, 378.67. Just amazing to see the 2-year back up at 450 right now, Tom. 2-year yield down by 3 basis points on the day, but we've done the work the last 10 sessions. Back through 4.5% at the front end of the curve.
Right now, and this is important, you need to reset for the weekend. You need to reset for the second half of 2023, and particularly if you've not participated in the 7 tech stocks. Mike Wilson will brief on the caution that is out there. He is at Morgan Stanley, their U.S. equity strategist, and has been, I'm going to suggest, cautious through thick and thin of this pandemic and forward. Mike, what are you writing this weekend to recalibrate a cautious call?
Yeah, good to see you guys. I mean, our call really hasn't changed. We're very disciplined on price. And as you know, we got tactically bullish last fall at 3,500 because that was a good price. And now we're, of course, back to the high end of the range, and that's not a good price. And that's at the S&P level. That's not really what's been interesting over the last 6 or 7 months. As you know, what's been interesting is what's going on under the surface. I would say in the fourth quarter, that was a very hated rally because it was led by kind of the old economy, financials, industrials, energy, materials. It was all based on, the China reopening story, which was legitimate. And technology stocks obviously disappointed, and they did not trade well in the fourth quarter. So it was a hated rally because that's what people own. Now, of course, the S&P is trading at the same price it was in early December when we got cautious again, and tech is obviously going to the moon. And now this rally is loved because this is what people want to buy. This is what people want to own. It's a lot more interesting and kind of exciting to own AI and technological revolution than it is to own those old economy stock that's, well, why do I want to own this long term? So it's just an interesting development. We would characterize this as the bear market is continuing. Okay, this is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. And we think the overriding driver, okay, of this year's rally has been increased liquidity. Liquidity has improved dramatically, both on a global scale, and the weaker dollar has helped. That's going the wrong way now again. And then, of course, ironically, the banking failures that happened in March led to an injection of liquidity from the FDIC and the Fed. And we think those things have really conspired to drive the market. I mean, nobody talks about the fact that crypto is up 60% this year, okay? And then the next one, of course, is the tech world. So this is what's going on. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
Mike, let's just talk about the index a little bit more, and great to have you with us as always, particularly going into the long weekend. Mike, you really started the debate this week on this program, and we reflected on your note from over the weekend into Monday when you said the following, that there are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market. There was a short list after that of those signals, and one was extreme narrowness, poor breadth. We presented that to Savita Subramanian, a peer of yours over at Bank of America, and she said narrow breadth is not a precursor for doom and gloom. Mike, I just wanted to give you the opportunity to respond to that. What is it about narrow breadth that you think signals something at the index level?
Well, I think you could debate this one way or the other, meaning when you make a market low, you typically do have severely negative breadth. That is a good sign. However, the index is usually down with it. So we think where we are is the index is telling you things are rosy, things are fine, and the breadth is telling you otherwise. And then when we put our fundamental overlay on top of that, which is, we're way out of consensus now on the earnings front, then we can make the conclusion that the internals, right, the breadth is being one of those, but the internals and the leadership is telling you that growth is going to be a problem in the second half of this year. Whether that's an economic recession or not, we think it's going to be an earnings recession that's way worse than what people are currently modeling. And look, I want to go back to the beginning of the year. You guys are good readers of our reports. You remember at the beginning of the year, I was somewhat nervous that everyone was in the same camp at that point. Our view is very consensus on the fire and ice, the tightening and then the slowdown. And so we were trying to figure out, well, how could everybody be right? That doesn't work. And so what we've done now is we've worked off that oversold condition. And more importantly, now I would say the consensus is actually optimistic on earnings again. And that's just where we completely disagree.
So, Mike, can we just build on the challenge to the index level, retesting the lows of last year, given the muscle of 5 or so names doing just ridiculous things, up 100% plus, Meta, Nvidia, etc. Is that a big enough challenge to the view that we can retest the lows of last year?
Well, not necessarily, not at all. In fact, it kind of sets us up where it's probably inevitable now, because what's happening is you're basically forcing people into these stocks at bad prices now. The valuations last fall on these stocks in particular was extremely attractive. And if you look at the performance of all of these names, with the exception perhaps of the one this week, which, earnings are going up, the earnings are not driving these stocks. It was 100% multiple expansion, which goes back to our liquidity question. So look, the price is wrong in our view, because the earnings are probably going to be wrong for most of these stocks, not all of them, but most of them. And so from here, we think it is still a stock picking game. And of those 6, 7, 8 stocks, my guess is 2 of them will probably be okay, and the other ones will not, because they are the economy. Okay, they can't avoid the economic slowdown and the top line slowdown that we see in the second half of this year.
Mike, maybe a bit off your remit, but I got to go here. Just percolating in the zeitgeist into June is the once again debate of active versus index usage in the equity market. Give us your update on the value of active versus the value of index investing.
Really interesting confluence right now, because you could argue both are working at the moment, right? Having the right stocks in your portfolio has been really the only way to make money this year. The problem is that those stocks are such a big part of the index. The passive person can say, look, my passive strategy is working as well. And so we still think active will have a comeback here as we go through the next couple of years. It already is to some degree. but boy, it's been, the market, once again, the market is doing a very good job of kind of fooling us into whatever we want to believe. We think active will be the place to be for the next 2 or 3 years. It's going to be a comeback there.
Mike, dovetail this with Ellen Zentner. Take the recession call of Morgan Stanley and dovetail into your caution on equities.
Yeah, so Ellen and team, I mean, they're not looking for a hard landing. What they are looking for, though, is a very sluggish economy. So it's sort of 0% GDP growth.
Right.
Now, that's fine if you still got price. Our view is that 0% GDP growth will lead to bad price. And we're already seeing that in the goods sector. And then we've done some consumer work recently, which is we're starting to see signs that even the high end is starting to pull back on spending intentions on services. So, services is 70% of the economy. It's, goods are 70% of the S&P 500 earnings. So in other words, the economy can stay kind of at zero, but that's not going to be a good outcome for S&P earnings in our view.
Mike, do bears eat lobster?
Well, we can't afford it because we're bearish. I mean, lobster's expensive. Plus, I'm cheap anyway, so
Mike, we'll try and hook you up with one. Thanks for appearing this morning. We appreciate it. Mike Wilson there of Morgan Stanley.
We got to do
on
lobster and hot dogs.
Honestly, the feedback is ridiculous.
Who cares about economics, finance, investment, or that? The price, we forget about this. Cullen Pistol in New York, $35 for a lobster roll. Beals, Gerard Cassidy, Beals is in Portland. There is a plaque, the Gerard Cassidy Memorial Stool at Beals. It's MKT is the price.
So what we need is Michael
$42.
O'Leary to come over here and start Ryanair, so we can fly from New York to Maine for $15.
Lunch with Gerard.
It'll be cheaper to fly up to Gerard and get a lobster roll there than get a lobster roll in New York.
A lot of money.
Okay, 8:30 Eastern Time. Don't miss this. Tom Keene sitting down with Megan Green of the Kroll Institute and future member of the Monetary Policy Committee at the Bank of England. That conversation coming up.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. A deal may finally be shaping up to avoid a catastrophic U.S. default. Sources say Republican and White House negotiators are closing in on a deal to raise the debt limit and cap federal spending for 2 years. The emerging agreement would include measures to upgrade the electric grid, speed permits for pipelines, and cut $10 billion from a budget increase for the IRS. Default worries are intensifying, though, in the U.S. as the Treasury's cash balance drops to its lowest since 2021. Data show it fell below $50 billion on Wednesday as the debt ceiling standoff does continue. The Treasury's bank account has been under downward pressure recently as the government implements measures to avoid breaching that $31 trillion debt cap. And wealth bankers in Asia at UBS and Credit Suisse will get a rare incentive for bringing in new money. They're going to get a cut of the cash equal to 15 cents for each $100 of new client money. That's according to people familiar with the matter. Asia was once a key battleground for the Swiss rivals, but they're now trying to show clients stability after that emergency merger back in March. And shares of Marvell Technology are surging in pre-market trading after the chipmaker said it expects sales of AI-related products will at least double this year. Adjusted earnings for the first quarter also beat estimates. It's the latest chipmaker with a rosy forecast on AI. Remember, NVIDIA's market value jumped past $930 billion on Thursday. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
I don't think we're in that world where equities is the no-brainer play anymore, especially not when you have such interesting yields in fixed income. And I think for investors, that's probably the consideration. There is money definitely on the sidelines, but I think the days of just buying equities blindly because you had easy monetary conditions are behind us.
That was Diana Amoa, the CIO of Long Buy Strategies, the Kirkoswald Capital Partners. Great conversation yesterday.
Yes.
This just in from Mohammed Al-Arian, reminding us, TK, that we have Frontier and Spirit Airlines to take us places, and that we don't need
Mohammed Al-Arian is
Mohammed's
flying Frontier. When was the last time Mohammed I can honestly say, for full disclosure, I've never been on Spirit.
I've been on Ryanair,
it's a great airline.
EasyJet too. I've never been on Spirit or Frontier.
Why isn't Joe Biden talking to O'Leary? Oh, come on in,
We've got Mohammed on in about 40 minutes.
Oh, we do, do we?
Yeah, we do. We
Oh,
do.
good.
We as a network,
As a
as a
network
company,
does.
we have.
Won't get out of bed for
Mohammed.
me. Know that for certain.
On London time, Tom, over in Cambridge.
It is an important day. There's a lot going on here. Data. We're going to lobster chat in a minute. We brought in a lobster. She's our chief lobster roll authority, Shonali Bassick, with us. But on a serious story today, which harkens back to leverage in hedge funds. And we're going to talk to her right now about risks and shadows and opaqueness that's out there from 2 years ago, or might I suggest July of 1998 as well. I'm going to go right to the top of your story. How leveraged is the leverage discussion of a bond transaction?
Listen, a lot of these trades are very significantly levered, sometimes 50 to 1 or more. And the reason this was always okay is because it's in the Treasury market. This is the most safe liquid market in the world.
Until it moves.
Until it moves. And now it's moving quite violently, as we know. And so we know that ever since the LDI blowups that we saw earlier in the UK, banks have been asking hedge funds to cool it, essentially. They've been asking for more margin. They've been reducing risk. But listen, a lot of this leverage comes from repo markets, sometimes sponsored repo, which is money market funds. So there are a lot of worries here under the surface in Treasury markets.
Gensler wants he wants clarity here. We got opacity in that. We understand we had a banking crisis because we really didn't know what was going on at SVB. Do we know what's his name, Griffin?
Ken.
You know, he's going to buy like the Miami Marlins and the rest
Citadel.
of Florida as well. Yeah. Ken Griffin, do we know what he's doing? Do we know his 50 to 1 leverage on these transactions?
Listen, these are called basis trades. They're fairly simple trades that arbitrage the difference between Treasury futures and spot. Citadel, Millennium, Exodus Point, Capula, Alphadyne. These are some of the biggest players in this space. Our sources say that Citadel is not as levered to the trade as they have traditionally been in the past, or as peak leverage has kind of gone before. But we know, guys, not only has this caused major losses among hedge funds in the past, the reason it's a problem is it's caused the Fed to step in. People forget that in 2020, the Fed has had to step in on this trade. And
Are they stepping in 2023? Do we know that within our reporting?
I think that's a lot of the problem here and why there's a worry here. There's a kind of implicit understanding in the market that the Fed does step in. They have to step in. The hiccups in the Treasury market are not of the making of the hedge funds this time. It's of Washington.
Yeah.
However, it's not clear that the Fed wants to bail out hedge funds again.
Just to be clear, why would the Fed have to step in? Why would that be called a bailout of hedge funds?
Well, it's interesting because in 2020, when the Fed stepped in, there was the pandemic going on. So it was more about the pandemic and less about the hedge funds. What's less explained is 2019, when they had to step into repo markets because of more drastic movements. And again, a lot of these hedge funds were levered towards the trade. This time around, if there were any major issues, you could say, well, we didn't cause the Treasury market volatility and we didn't cause the downgrade.
I want to make this clear. Are there major issues now, or are we reporting that there seem to be shadows from 2 years ago?
No, there are issues now. There are issues. The reason there are issues is not that these trades are blowing up right now or anything like that. It's the issue that what underpins these trades is repo leverage and this idea that if there were any potential downgrade in the Treasury, then all of the collateral underpinning these trades are not worth what they were yesterday. So there are real issues in the market that the debt ceiling does exacerbate to some degree. But again, these are highly levered trades and a lot of the leverage is bilateral. So it's very, very opaque. Guys, changes have been planned or talked about since the Obama administration. It's not really changed much at all. And when you see such violent moves in Treasury markets, that's when banks and regulators start to ask questions.
Is there a danger, though, that we're blaming hedge funds for something that is the responsibility of politicians in Washington and poor policymakers at the Federal Reserve?
It's not blame per se. This is kind of a market structure question. There have been a lot of calls in recent years to make this market more transparent, and it hasn't really gone that way. And so when we're thinking about what happens now and the potential risks, I think, even if you're all clear, we have to remember that this is a market with a history of blowups. This is a market that there have been asks for change. And, by the way, it could be forgotten about if they have a debt ceiling compromise here and some of these issues.
I get the rating decrease idea, even on a 50 to 1 leverage. And I have the clearest memories of learning how you get from 3 to 1 to 12 to 1 to 22 to 1, whatever it was with LTCM. But to John's key question here is, well, what's the so what here if they're just hedge funds and if they lose money, why do I care?
for the
if
pure
Bobby
facts,
Axelrod goes under, who cares?
Listen, you're making the hedge fund point, which is, hey, we don't see blow ups.
I'm just trying to get on billions here. Play with me. We'll get on billions.
Yeah, no, and
help me here. What's the so what here if the hedge funds get hammered on this?
Don't forget that the Fed has had to step in before. That is the problem. If there are moves that are already violent, that are then exacerbated because you have a ton of leverage in a market as well, and that creates moves that are more violent in repo markets, which, by the way, matter to markets that are not just hedge funds, that's the worry here, right? Toying with a market that is supposed to be the underpinning of the entire capital market.
I mean, Shonali, as our chief Hamptons correspondent, seriously, she's the one with the most distance here. What's the distinction between a lobster roll in Southampton versus way out on Montauk?
Wow, there were a lot of restaurants recently purchased, weren't there? You're probably paying a lot more for them.
Big season in the Hamptons for the hedge fund crew?
Yeah, I would say so. I mean, obviously they're trying to get out there, but remember, people expect deal activity to come back after we have this debt ceiling issue resolved and after the Treasury general account build and all these arcane things that we're talking
that's
about.
The hope.
With the debt ceiling issue.
That's the hope, but
listen, they're
the
staffing
why?
up. Like if into the summer, staffing levels are going to stay high. People are worried about things like, guys, there's so many risks under this market. That's what this story is telling you. And regulators and bankers are asking about it. So the idea of taking a whole lot of time to chill out this summer is not a popular idea.
I just don't get the Hamptons thing. I don't think I ever will. I just don't get it.
I'd rather watch paint dry. I'd have to be honest with you.
I just don't get
It's
it.
not my...
Not your scene.
You're out there 3 out of 4 weekends of the month.
It's not Shonali's scene. I just don't get it. I don't get it at all. Fly to Europe,
well, that's a different story, John.
If you've got that kind of money, if you've got that kind of money,
that's happening.
Or even if you don't fly to Europe.
Yes.
But what about for mere mortals that can't fly to Europe, once every 4 weeks, once every 5 weeks?
Spirit Airlines.
Well, they've probably not got $100 million houses in the Hamptons either.
You go down to New Jersey, right?
What's wrong with Jersey? You used to go to the Jersey Shore.
It's a different thing.
Different vibe?
Yeah,
This is where I'm
from. It goes back to gas.
What's the Jersey Shore Hamptons distinction? That's the question you should ask Shonali. She's a New Jersey girl.
History, what?
I like to say it's pure grit.
That's the difference,
Personality, grit, music.
Okay, keep digging. Music, true.
Music, big difference.
Springsteen.
Big difference. Big difference.
Very cool. Shonali, this was great. Appreciate it.
Shonali, thank you. A
Hedge
very
funds.
important report.
Offended a couple of people along the way. Why not? Okay.
Important
Mohammed,
story.
coming up, 35 minutes away. Looking forward to it. Mohammed Al-Erin of Queen's College, Cambridge. Looking forward to that. And we'll catch up with Sima Shah of Principal Asset Management as well. Krishna Mamani of Lafayette College going into the opening bell. To close out, I've got to say, Tom, you know what? Things got interesting again this week. Globally.
Well, I would like to suggest
Guilt,
team surveillance predicted
inflation in the UK, the moves in the Treasury market, AI.
Yeah. What am I watching?
Breakdown in the euro. It's interesting.
We're not talking Japan. Euro yen 150.23. I mean, at resistance. Interesting to see what they do with the economics of Japan over to YCC.
I'm going to run if I don't see you, TK. Have a nice weekend.
Yeah, well, lobster roll breakfast. We can do that.
I'll see you soon in about
Redo keeper of the
35 minutes
Amex would
time.
love it.
They're going to pay for this.
What about this? $200?
Expense. Yeah,
This
about
is
that.
Bloomberg.
Research.
Good morning.
Research.
Bloomberg Surveillance, good morning, everyone. Lisa Abramowicz, Jonathan Ferro, and Tom Keene. Thank you so much for the response today. We're having fun on a Friday before the celebration of Memorial Day, the remembrances of Memorial Day as well. We hope you have a great weekend. The celebration in the market is simple. Futures up 8, doing better through the early trading. You got to believe smaller trading today. Dow futures up 50 points. I did that for John Ferro. The VIX 18.52. There is 2 Bloomberg screens of economic data through the morning, with Michigan coming up later, a Kansas City statistic. Michael McKee has the unenviable task of literally looking through 20 items and the 4 pages of data behind each of those 20 items. What do you see, Michael McKee, this morning?
Well, I see the durable goods orders out right now, but we don't have the personal income numbers yet because I think everybody is hitting the internet at the same time. There we go.
There they go.
Personal income, 0.4%. That's better than the 0.3 last month, and it matches the estimate. Spending, though, stronger than anticipated, up 0.8% compared with a flat reading in March. PCE deflator, this is the news the Fed is watching, is stronger, 0.4%. That's up from 0.1 last month, and it's stronger than the consensus forecast. Puts us at 4.4% for the headline number over the March number of 4.2%. Core is up 0.4, which is stronger than anticipated.
Yes.
And that puts us at 4.7% from 4.6%. So if we're just looking at these PCE numbers out of this release, you're seeing a lot of pressure being generated on the Fed to maybe raise rates one more time. We'll check in on what the bets are on WIRP, the Bloomberg function, in just a moment. Durable goods orders up 1.1%. That is compared with a 3.3% increase in the month of March.
Right.
Durables ex transportation down 0.2. So we probably got some Boeing in there. Capital goods orders, non-defense ex aircraft 1.4%. That compares with a 0.6 drop. So one of the things in the first quarter, Tom, that was a concern was that business spending had dropped off. And when we got the revision to GDP yesterday, we saw business spending raised a little bit, and this looks like it's contributing to maybe a return of business to the world.
Take a breath. Look at the data. This is really tough. This is what McKee does better than anyone in the world, folks. It's like 3 days. It feels like 3 days of economic data on steroids. And what it is the markets were going to react. Moments ago, the 2-year yield to 4.56%. Critically, this is not about the intraday chart. On radio, we're showing the intraday chart, and yes, up it goes to a 4.55. Far more importantly, we're getting up to where we're breaching the high yield that we saw in the 2-year of a number of days ago. The curve inversion is further. We go to negative 75 basis points, a difference in yield between the 2s and the 10s. Critically, the 10-year real yield adjusts higher, 1.56% there. These are all global Wall Street key data points indicating a little angst out there about the stickiness. Michael McKee, from where you sit with 15 major data points in Michigan coming up, is this a sticky inflation sum of data?
Oh, sure. And it is not particularly good news for the Fed. One number to give you beyond where we were, 4.1% is the personal savings rate, drops down from 4.5%. So Americans did dip into their savings to spend what they spent. And of course, as we mentioned, spending was up on the month by 0.8 compared with just 0.1 in March. This is going to be a problem for the Fed. This is their indicator. This is the one that they watch and they base policy on, and it is going the wrong direction. Now, it's not that they didn't think that would happen. They expected some volatility and lumpiness in the numbers, but about half of them or more said in the minutes and have said in speeches since then that they're going to probably need to raise rates more. So then the question becomes, do they do it in June or they do it in July? And this kind of moves up the timetable, one would think, to perhaps June.
And what's important here is the vector. I'm not going to do this because we'll waste time getting to Megan Green, and we don't want to do that. But Mike McKee, really simple here. We peaked on PCE deflator year over year, 5.46%, I'll say, in early 2002. And I'm sorry, a vector is in place to disinflation there. But is it tested this morning? Is the vector really under threat of disinflation?
Disinflation, it's not under threat at the moment. I mean, we're looking for that kind of progress, but so far we're not getting enough restraint from the Fed's interest rate increases to get us there. And Tom, I told you I'd look this up. We're now up to an 86% chance of a move by July, a 46% chance of a move in June. Those are both significantly higher than they were before these numbers came out.
Michael McKee, thank you so much. Futures up 3, Dow futures up 21 as well. As you know, over the years, I've made clear the Bank of England simply does it better. Maybe it's because it's a surprisingly new public institution versus the Fed and all the codified history of the Fed. But what they do more than anything is they take in people with different views. I think of Adam Posen, now at the Peterson Institute, IIF, I'll get it right, International Economics, Peterson International Economics in Washington. I think of David Blanchflower at Dartmouth. And now they go brilliant in a number of months by bringing in somebody really original in economic analysis and policy discussion, Megan Green of the Kroll Institute and, of course, of Brown University. She will join the Bank of England, and obviously with those constraints, she cannot speak about the Bank of England. She cannot speak about the United Kingdom. We checked with her entourage. She cannot speak about the future of Tottenham Spurs, and she can definitely not speak about the politics between Cambridge and Oxford. Is just too deep and too dangerous to go to this morning. Megan, congratulations on this hugely important appointment. I wanted to talk today about the American economy and the certitude we have of guessing vectors of inflation. You're expert at the history of the study of that. Can we actually game a vector of inflation?
Yeah, look, the inflation data was always going to be bumpy coming down, and that's what we're seeing. But I think what we can gauge is sort of underlying trends and look for signs of persistence of inflation in the U.S. The core capital goods data that just came out surprised on the upside. That's about 70% of fixed investment, so that suggests that demand's pretty strong in the UK economy. And core PCE was stronger than many had hoped. So, I wouldn't read too much into one data point, but it does suggest that the Fed isn't done. So even if the Fed does end up pausing, I don't think it's finished here.
Right.
We've seen that corporate earnings have been pretty strong. That means that there's a lot of labor hoarding that may well continue, keeping the labor market strong. That, again, keeps demand strong, keeps upward pressure on inflation. So I think that the Fed's got more work ahead of it.
One of the Megan Green realities is plain language. You actually speak in English. Thank you for that. That'll help you with the Bank of England. You speak of this as a weird time in history. Define that phrase.
So it's a weird time in history, just given the successive shocks that we've had on the economy between a pandemic, a war. A lot of the indicators aren't really responding, particularly to tightening of monetary policy, as one might expect. And the labor market here is a great example. The labor market is holding up freakishly well, given how much aggressive tightening there's been in the U.S. And as I just said, that keeps demand really strong. And so the Fed's trying to sort of kill off demand to bring it back in line with supply so we can see price stability. But it's just not transmitting, monetary policy is just not transmitting into the real economy as we expected it might.
Dominic Constant was on earlier with Mizuho, also out of Oxford, and he made very clear that there's a partition between demand-driven inflation and supply-side inflation. Obviously, that's a pandemic inflation. Are we still living the pandemic in the wall of data seen in America this morning? Are we still living the pandemic in our funny savings ratios and what that means for income and spending?
I think we are. It's a bit too early to say how long that will actually last, but we're seeing it in consumption patterns. We're seeing it in people's decisions to leave jobs, to move. We're seeing it in the real estate market. So the pandemic is very much still with us. And I think some things will structurally change going forward as a result of the pandemic. We're just not sure exactly what it is. If you look at the labor force participation for different demographics, overall, it's recovered in the U.S. It took a really long time, but there are differences, particularly among older workers. And I think that will be with us for a while. That said, we really struggled with supply constraints, not just in the labor market, but also, of course, with global supply chains during the pandemic and in the immediate aftermath of the pandemic. And if you look at a bunch of gauges for global supply chain tightness, it's actually eased quite a lot. So I think that piece has eased, and yet inflation remains stronger than what we'd hope.
Okay, inflation is stronger than we hope, but there's a belief there of getting back. Now, I don't want to get you in trouble with Bank of England here, but the former vice chair of the Fed, Richard Clarida, and others are debating a 2% idea. Would you suggest the greater theory of our macro policy forward is going to be an adjustment of any given central bank's band or target that they're getting back to?
So we're certainly beginning a debate about that, I think, among the intelligentsia, but I don't think we've made much progress on that. Some are calling for a higher inflation target in the U.S. in particular, somewhere around 3%. The Fed and most other major central banks have defined price stability as a symmetric target around 2%. What the academic literature shows is that actually, until inflation gets above 4%, most people don't really notice it.
Yeah.
So I'm not sure. They don't notice inflation, at least, in terms of, the hit to their actual standards of living. So whether it's 2% or 3%,
right.
That may be more of an academic debate.
You absolutely nailed this. I got 1 minute left, Megan. I'm sorry, but this is research out of VCU that Olivia Blanchard is calling sentient inflation. Are we anywhere near sentient inflation where we're just comfortable with our inflation rate?
So no, I don't think we are near an inflation rate that we as the public or that the Fed's willing to tolerate in the U.S.
Right.
I think it will need to come down closer to the 2% target before the Fed's really ready to hang up its boots and be done with it. So as I said, we might get a pause in June, but I wouldn't take a pause to mean that the Fed is done. I think there's more work to be done.
Megan, very quickly here, and I'm really trying to stay away from the Bank of England police here, and I think I'm safe going here as well. One of the great things about Fenway Park, Megan Green, and it's not Narragansett Lager beer, it's the Yankee Lobster Company. Can you give us a rating on the lobster roll from the Yankee Lobster Company at Fenway Park?
I can't, Tom, because why would anyone ever get anything but a Fenway Frank at Fenway Park? So I've never had it. I stick with Fenway Franks.
Bottle that, and you will see that as she enters the August doors of the Bank of England. Megan Green, congratulations from the Kroll Institute. And she's 100% correct about hot dogs and beer at Fenway. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Madison Mills. Republican and White House negotiators are said to be moving closer to an agreement to raise the U.S. debt limit. Sources say the emerging agreement would cap federal spending for 2 years, permit defense spending to rise 3% next year, and offer concessions to both parties on energy. If a deal is reached soon, a vote in the House of Representatives could take place as early as Tuesday. And economists now think China's central bank will cut the reserve requirement ratio for major banks by 25 basis points before the end of the third quarter. That's earlier than they'd previously anticipated. This comes from Bloomberg's latest survey. They also pared expectations for GDP to 5.5%. And Bloomberg has learned that UBS and the Swiss government haven't agreed on the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of that takeover, including capital requirements and liquidity rules. And Peter Orszag will become Lazard's new CEO on October 1st, succeeding longtime chief Ken Jacobs. Orszag currently leads the firm's advisory business. He'll have to contend with a slump in deal-making that's been weighing on profits. Jacobs will become Lazard's executive chairman. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Madison Mills, and this is Bloomberg.
You're always flying blind in this economy. There's a lot of choppiness, there's a lot of noise out there. I mean, the big picture here, I think, in terms of the economy is it continues to expand. It seems at they call it modest pace at this point.
Bloomberg surveillance, Jay Bryson there from Wells Fargo, really giving a wonderful perspective yesterday. This has been, in all the years I've been doing this, folks, to my team, I can just simply say this has been the strongest Friday before Memorial Day that we've seen. As John Farrell mentioned, it's been an extraordinary week. We saw this Monday, Tuesday, and it doesn't end today. The 2-year yield, 4.58%, is a wow statistic. The inverted yield curve goes from negative 50, 4 cups of coffee ago, to negative 76 basis points. The real yield maybe not getting the press it should, but the 10-year real yield, 1.55%. I want to take 30 seconds here on Peter Orszag. He was definitive at the London School of Economics. This is one of the rarest times where you see within Wall Street a true academic and policy wonk vault to being the chief executive officer of one of our storied names. This is, of course, Lazard Frères. Peter Orszag owns the high ground on research on our terrible medical system. I know it's not as bad as England and that, but as a young Turk, he was absolutely definitive in changing the debate on healthcare in America, and particularly on the processes of our complete garbage retirement system. I can't say enough about that. When you hear me say the phrase glide path, which is basically mathematics and Newtonian calculus, maybe it's from his father, iconic at Yale, but when you hear the phrase glide path, that's a direct steal from Peter Orszag. This is an inspired announcement by Lazard today. Okay, Future's up 4, and we're going to get to the only interview that matters, and we're not going to talk about lobster rolls with Helene Becker. She is senior, what in God's name is going on with the airline industry analyst at Cowen, and joins us today. Helene, I'm going to talk with a safety issue. The Wall Street Journal had that BARS chart yesterday on collisions and near collisions of aircraft. Why are we seeing that?
Yeah, I just think there's a lot going on in the airline industry right now in aviation. Airports are really packed, as you know, and the runways are equally as crowded. Kind of rush, think of cars on the highway at rush hour, sort of same for the planes. I want to say, though, Tom, that the U.S. aviation system is safe, probably one of the safest in the world. And these runway issues, I think, are just temporary as we work through some of the issues that are out there.
How far are we back to the summer of 2019?
We're there. We're past there. What I find amazing is we're forecasting beginning yesterday through Monday, Labor Day. So that kind of a little more than 3 months, 275 million people will travel via air this summer. And that is an increase over where we were 4 years ago, where we were last year, double-digit increase over last year, mid-single digits over 2019. So really strong summer.
What is the constraint moving forward to a better experience? Is it the planes? Is it the pilots? I saw an article that some pilots don't want to be promoted because it's not worth the money, etc. What's the Helene Becker constraint limiting us to a better experience?
Yeah, I mean, look, I think it's just the level of people and the lack of infrastructure. We've been talking about this for years at this point, probably since 2013, actually. In terms of pilots, the most senior pilots are retiring or have retired, and they're being replaced with younger pilots who just have to get up to speed. Not unsafe. I just want to reiterate the fact that pilots who work in the U.S. air system are as safe as can be and are well trained, and that's really important. But we do have a lack of air traffic controllers. Secretary of Transportation said a couple of weeks ago we were short 3,000. And when you think about how long it takes to become an air traffic controller, you realize we're going to be short thousands for years. This is not a problem that's going to be resolved this year or next year. It takes at least 2 years to 5 years to become proficient. And Tom, you mentioned pilots don't want to move from the right to the left seat. Well, controllers don't want to live in New York, Chicago, San Francisco, LA, Miami, where it's really busy and really expensive to live. They don't make enough money to afford to live in these cities.
Let's switch to the securities analysis of the moment as well. I've been thunderstruck how, to pick on United Airlines, Fortress Kirby, that, they collapsed in the pandemic, they bounced off a little bit, and they've really gone nowhere. Are airlines the mother of all opportunities, Helene Becker, to rebound to pre-pandemic pricing?
Prices, yeah, I think they are. I think we're going to have a record summer, as we talked about. I think, as you point out, the stocks are back to 2020 lows for the most part. And the pushback I get from investors is this is as good as it gets. Pricing's very strong, demand is very strong. And why will this continue, especially if we head into a recession? And the way I think about it is we're back to 2019 levels in terms of passengers, but capacity is down between 10 and 15%. And so you've got more seats per departure. They're up about 15%, 14%, but
Right.
you have fewer departures per day. And so you've got 90+% load factors, which makes recovery from irregular operations difficult. But in terms of valuations, the airlines are going to make a lot of money, and nobody believes it. Nobody believes this is, or investors for sure don't believe this is sustainable.
One final question. Is our fleet aged? A guy named O'Leary was in here this week. He runs a small airline, and I think it's out of Ireland, called Ryanair. I'm trying to get Ryanair to come over here, Elaine. I've failed so far. And he's talking about the purchase of 300 airlines from Seattle, Chicago, wherever Boeing's going to land here in the next 12 months. And the answer, Helene, is I'm worried about like the age of the fleet. It seems to be okay. Am I right?
Absolutely. So American has one of the youngest fleets. They refleeted between 2014 and 2020. This is a lower year for them for CapEx. United's in the middle of refleeting. They were the ones that didn't actually retire any wide-body aircraft during the pandemic, while the other two big airlines, American and Delta, did. Delta's been refleeting. So yes, we have a relatively, having gone maybe a decade ago from the oldest fleet in the world to right in there, right in the mix, and on its way to the youngest.
Helene, one final question. The youngest afterthought emails in and says, can you ask Ms. Becker the wonderful cookies that Delta serves? When they come down the aisle with the tray with the cookies and the potato chips and all the stuff she tosses into her bag, do they pay for that stuff, or is that like given to them free because people want the advertising?
No, they pay. That's included in their food budget.
Okay. I learn something every day. Helene Becker, thank you so much. With Cowan as well. Really, really, really interesting time. And I'm sorry, folks, this is something we're going to do, and I really can't say enough about Bloomberg News aviation coverage. It is truly world class. And, you see like the graph rather in the Wall Street Journal, and you got to lead with this stuff about, okay, we've come through this terrible pandemic. We're back. And what I'm hearing from Helene Becker there is maybe a lack of experience out there in the different parts of our transportation system. Stay with us through the day on radio and television. We'll give you really nationwide any of the slowdowns that we see. Should point out, for those of you thinking LHR, serious British Airways problems over the last, I believe, 2 days. Once again, BA has technological difficulties that have led to some real disasters at Terminal 5. Not disasters, that's not the right word, slowdowns at Terminal 5 at LH. Our futures up 5, Dow futures up 32. What I can say for Lisa and John, it's real simple. We have a changed yield landscape, 4.59%, up 5 basis points further from the ginormous move yesterday on 2-year yield is the headline statistic. We didn't talk anything today about the oddities of the 3-month T-bill market, given the debt coverage. Look to balance of power today and our government coverage through the weekend on the debt crisis. It'll be interesting to see. I would assume there'll be no let up on that through the weekend, and that's expressed in our world in the 3-month Treasury bill, 5.31%. Less stated here is crude with a little bit of a bid here over the week, 72.63 on West Texas Intermediate. Will Kennedy saying that's still pretty darn cheap as things go. DXY 104. We're watching Euro, not a 106 print yet, but Euro worked weaker through the week. Coming up on lobster rolls, El Arian of Queens College. This is Bloomberg.